Hi, hello my dear CA final students, welcome to the amendments video related to September 25 indirect taxes. So this particular amendments video we are going to cover all the amendments from November 1st 2024 to February 2025. Why like that? Because now that ICA has converted 2 attempts to 3 attempts. So previously it was May and November. So May exam, whatever are the changes which were applicable up to 31st October were applicable for May, and for November whatever changes which were up to 30th April were applicable for November. But now what has happened, as the September attempt came in between, so therefore the same logic. So the logic is that 6 months before, so up to February 2025, whatever amendments are there, that is applicable for September 25 exam, and whatever updates that were there up to June 30th will be applicable for Jan 26 exam. So if you are appearing for September 25 exam, all updates up to February 2025. Then if you have already attended May 25 exams, you would have studied the May 25 amendments. So now along with that May 25 amendments, if you are appearing for September 25, you need to cover these amendments also, that is amendments between 1st November 2024 to 28th February 2025. Okay, this video focuses on that. Suppose if you are appearing for the first time September 25 exam, May 25 amendments also you should be careful with, because this particular attempt, this September 25 exam, I am expecting more amendments from May exam as well, because May 25 not much amendments were tested. May lot of amendments were there, not all those amendments were tested for May exam, but those amendments will be tested for September, plus in addition to that some amendments which are applicable for September also. So you need to be thorough with this. And if you want to know where these amendments of May 25 is there, you can just check my YouTube channel, and I will also give that in the description to this video. So you can see the May 25 amendments video also in addition to this. If you have not appeared for May 25 exam, this is the first time you are writing September 25 CA final exam. Trust me, May 25 amendments and September 25 amendments, easily you can score somewhere like 40 marks. Minimum to minimum 40 marks. Trust me, my intuition will not go wrong. It's just the research, based on that I am telling you. 40 marks to minimum you will be getting from May and September 25 amendments. Okay, then so how to get these amendments for May 2025 and September 2025? You can just go here, you will be able to identify here CA final amendments for September 25 exam in downloads, in my website under downloads, and even May amendments is also given here. This is the May amendments, this is for May amendments. Okay, and this one, the previous one what you have is September 25 amendments. You need to just download this September 25 amendments if you have already appeared for May 25, because all those things you know, just you need to focus on this. If you are appearing first time, my advice is to do both. Even if you are appearing already written May 25 but you want to appear again, go through these two amendments once again, nothing wrong in that. These amendments you should be pakka, perfect with, and so that you will be able to get very good marks. So now we are moving on to the amendments in the first segment. So here I gave the index related to what are all the various amendments that you have, and we are moving on to the amendments of the first segment, that is introduction to GST. In this we have already some non-taxable supplies. What are the non-taxable supplies under GST? We know alcoholic liquor for human consumption and petroleum products, correct? So in that, petroleum products, total 5 petroleum products: crude oil, petrol, diesel, aviation turbine fuel and natural gas. There is no change in the petroleum products. And why is it called as non-taxable supplies? Because as per the constitution there is no levy of GST on these supplies, and so petroleum products will come into the ambit of GST as and when decided by the GST council, but alcoholic liquor for human consumption is completely outside the ambit of GST. Now When it comes to alcoholic liquor for human consumption, now they have added two more products, that is denatured extra neutral alcohol and rectified spirit used in manufacture of alcohol. These two goods. Why? Because these two are basically raw material for manufacture of alcohol. And what happens, I am an alcohol manufacturer. Now I will buy some raw material to make the alcohol. Now my finished product is not chargeable to GST, which means on the raw material I cannot take ITC, whatever GST paid I cannot take ITC, correct? Alcoholic liquor for human consumption is non-taxable. Non-taxable means it will be coming under exempted. When it is non-taxable or exempted, I cannot take ITC on my inward supply, correct? So, but the major raw material for making alcohol is these two, denatured extra neutral alcohol and rectified spirit used in manufacture of alcohol. On this, if ITC is not available, that is going to add to the cost. For that reason, what government did now, they have amended section 9 and through Finance Act 2024, but it is effective from 1st November 2024, because of which only it will be applicable for September 25 exam for the first time. And these two goods are also kept under non-taxable, which means on this there is no levy of GST. So therefore, alcoholic liquor for human consumption and undenatured extra neutral alcohol, okay, undenatured. So this is not denatured here, undenatured extra neutral alcohol, you can see here, undenatured extra neutral alcohol or rectified spirit which is used in the manufacture of alcohol, these also excluded from the ambit of GST. So when you remember now, alcoholic liquor for human consumption, undenatured extra neutral alcohol, rectified spirit, these three are also non-taxable. Sir, what about other raw materials or other inward supplies of the manufacture of alcohol? That is subject to GST, we don't have any relief there, but the major raw material is these two, for that only they have given the relief, okay. And so now what will happen to the position of goods under GST? So previously only on alcohol there used to be state excise duty and CST and VAT. Now on denatured extra neutral alcohol and rectified spirit used in manufacture of alcohol, as there is no GST, the old indirect taxes, that is the state excise duty, will be applicable on manufacture and CST and VAT will be applicable on sale. If it is interstate sale, CST, intrastate sale, VAT, okay. So previously it was subject to GST and now they have brought it into exclusion from GST, which means the old indirect taxes will continue to be applicable on these also. Like alcohol, how old indirect taxes were applicable, even on extra neutral alcohol and rectified spirit used in manufacture of alcohol also there will be state excise duty. And when state excise duty will be applicable, state excise duty is applicable on manufacture. Remember, central excise duty and state excise duty is on manufacture, CST and VAT is on sale, okay. So state excise duty is when upon manufacture, on manufacture, state excise duty is on manufacture, whereas CST or VAT is upon sale, on sale of these, okay. This is what you need to remember as the amendment for the first chapter, that is segment 1, introduction to GST. Let's move on to the amendment in second segment, that is supply under GST. We all know that 7 subsection 2 deals with exclusion from supply. So 7 subsection 1 inclusion, 7 subsection 2 exclusions and 7 subsection 1a classification of supply into goods or services. In that 7 subsection 2 exclusion from supply read with schedule 3, there are some list of activities on which there is no GST, it is excluded from supply. This is neither supply of goods nor supply of services, and you would have remembered that as spalled slow, okay, spalled slow. Now change that because they have added 2 more activities into exclusion from supply. First we will see what are those 2 more activities which are added as excluded from supply. The first one is insurance services jointly supplied. What is the meaning of that phrase? Insurance services jointly supplied means, that is co-insurance services. Let's try to understand this with the help of an example. What is the meaning of that co-insurance services? Say for example, there is one person who is having a factory building and that factory building, so they wanted to take the insurance. And what is the value for which they need to take the insurance? Say this particular factory building is worth 400 crores. Okay, so this factory building is worth 400 crores and they wanted to take insurance with respect to, that is fire insurance or general insurance with respect to this factory building. But the problem is that, so one insurance company will not be able to give the entire coverage. So therefore there are total 4 insurance companies which formed a consortium. Consortium means what? Group. Okay, consortium means group. Consortium. So consortium of insurance companies. How many insurance companies? Total 4 insurance companies. So insurance company A. So insurance company A, then insurance company B, then insurance company C and insurance company D. So total 4 insurance companies, they formed a consortium and together they are providing the insurance services for the factory building. Together they are providing insurance services and this is known as co-insurance. Got it? So when more than one insurance company as a group provide the insurance services to the insured, so here the factory building is the insured. Okay, so then it will be coming under co-insurance. Now what happens? This particular insured will be paying insurance premium. How many payments he will make? Only one payment to the consortium. Okay, so in this particular case, say the insured has made the payment of premium. So what is the premium that is being paid? Say the premium is somewhere like 1 crore has been paid as premium. 1 crore has been paid as premium. Now to whom they will make the payment? So 1% they need to make the payment. Now let's take insurance company A as the lead insurer. So out of the 4 insurance companies, one person will be called as a lead insurer. So in this case, the insured will make payment to lead insurer A 1 crore and thereafter the lead insurer A will distribute that money to these 3 insurance companies. Are you getting this? 1 crore received by lead insurer A and thereafter they are giving to the other insurance companies. Say for example, say somewhere like 25 lakhs given to insurance company B, 30 lakhs given to insurance company C and somewhere like 5 lakhs is given to insurance company D. So what is happening here? So 30, 40, 50, 60 lakhs they have shared and they retained 40 lakhs. Is it clear? So 40 lakhs is what they have retained, who lead insurer has retained. So retained 40 lakhs, retained 40 lakhs. Now what is the treatment? What was the treatment before this amendment? Before this amendment, what we used to do? Simple. Lead insurer A will pay GST on 1 crore. Lead insurer A will pay GST on 1 crore. And whenever they are making the payment of 25 lakhs, 30 lakhs and 5 lakhs, they used to ask insurance company B to pay GST on 25 lakhs and raise invoice to insurance company A. So I am talking about before amendment part. Before amendment, what has happened? Okay, before amendment I am talking about what has happened. Before amendment, what used to happen is that, so insurance company A and there will be insured. So insurance company A will raise invoice for 1 crore. Accordingly, their gross liability, output tax, if you see, so 1 crore into GST, let's take 18%, they used to pay. Thereafter, this insurance company B, insurance company C, insurance company D, so insurance company B will raise invoice for what? Invoice for 25 lakhs. 25 lakhs is what they have got now. So 25 lakhs. Insurance company C will raise invoice for 30 lakhs and insurance company D will raise invoice for 5 lakhs. Got it? Now insurance company B when they pay GST on 25 lakhs, they will pay GST on 25 lakhs, okay, and as they raise the invoice, so there will be input tax credit. Input tax credit. So what is that input tax credit? That input tax credit will be 25 plus 30 plus 5, that is 60 lakhs. 60 lakhs into 18%. So net amount is what they will be paying as GST. So B will pay GST on 25 lakhs, C will pay GST on 30 lakhs, D will pay GST on 5 lakhs, and A will pay GST on 1 crore. And B, C, D, whatever GST they paid, that A will be able to take ITC and adjust against the GST liability. This was the position before the amendment, okay. Now, after amendment, what has happened here? After amendment, what has happened? After amendment, so because of this addition of this co-insurance services, where lead insurer distributes the money to the other insurers, is excluded from supply. That is amendment. What is amendment? Insurance company A collecting 1 crore is not excluded from supply. That is covered under supply. Insurance company A in turn will distribute the money to B, C, D, na? That was excluded from supply. So which means here what happens? So insurance company B, insurance company C, insurance company D will not raise any invoice. So whatever services that are, whatever money that is collected by them is excluded from supply, not a supply. So that 25 lakhs, and so whatever money that they are receiving, who is receiving? B is receiving from A, and C is receiving 30 lakhs from A, and D is receiving 5 lakhs from A. All these three is not a supply pa. All these three is not a supply, which means will not be chargeable to any GST. But A is collecting 1 crore na. A is collecting 1 crore from insured. A is collecting 1 crore from insured. That 1 crore is treated as supply. That 1 crore is treated as supply, and A is required to pay GST on rupees 1 crore. Is it clear? That is post amendment. Why it is like this? A has to pay. See, even before amendment also A used to pay GST on 1 crore. Now also he will be paying GST on 1 crore. But previously they used to get the input tax credit, means effectively they used to pay only on retain. That is, what is it, retain? 40 lakhs. But now what has happened is that B, C and D, that is the other insurers, co-insurers, will not be paying any GST. It is excluded from supply. Only the lead insurer will pay GST, that is on 1 crore. Okay, that is with respect to this year. And so that is what you can see here in the point. So apportionment of co-insurance premium by the lead insurer to the co-insurer. Apportionment of co-insurance premium by the lead insurer to the co-insurer. Okay. In co-insurance agreements or arrangements where multiple insurers provide coverage, in co-insurance arrangements where multiple insurers provide coverage, the lead insurer often collects a premium from the insured and distributes a portion to the co-insurers. The proposed provision treats this apportionment of premium between the lead insurer and co-insurer as neither supply of goods nor supply of services, provided the lead insurer paid GST on the entire premium. See this, provided that the lead insurer paid GST on the entire premium paid by the insured. So see this question related to that point. Question number 1. The New India Assurance Company Limited, a registered insurance company in India, enters into a co-insurance agreement with ICICI Lombard General Insurance Company to jointly provide insurance coverage to Reliance Industries Limited. So New India Assurance is one company. Another company is ICICI Lombard General Insurance. Okay, these are the two insurance companies. So New India Assurance and ICICI Lombard. So to jointly provide, what is that? To jointly provide insurance coverage to Reliance Industries Limited. The total premium paid by Reliance Industries for the policy is rupees 10 crore. As per the co-insurance agreement, New India Assurance acts as the lead insurer, collecting the entire premium from Reliance Industries and subsequently apportions 40% of the premium to ICICI Lombard. So basically, two insurance companies. What are they? New India and ICICI Lombard. They provide services to Reliance Industries. What is the total amount of premium? 10 crore. And what happens is that New India Assurance acts as the lead insurer. They collect 10 crore and 40% of the premium, 4 crore, they are giving to ICICI Lombard. New India Assurance pays GST on the entire premium amount of 10 crore as required by the law. The applicable GST on insurance and reinsurance is 18%. Calculate the GST liability for New India Assurance on the premium collected from Reliance Industries Limited. So what is the GST? Gross GST, net GST, both are same. They will not be able to take ITC because the other person is not required to pay any GST na. So 10 crore into 18%, that will be 1 crore 80 lakhs will be taken, 1.8 crores. Then that is the answer for this first part. So services provided by New India Assurance Company Limited to Reliance Industries Limited against consideration of rupees 10 crore, it's treated as supply under 71A, GST payable by New India Assurance and FCM. So 10 crore into 18%, 1 crore 80 lakhs. Then determine if ICICI Lombard General Insurance Limited is liable to pay any GST on the 4 crore premium apportioned to it. No, they are not required to pay any GST. So ICICI Lombard General Insurance providing co-insurance to lead insurer against a consideration of 4 crores is excluded from supply as the lead insurer paid GST on the total premium. Okay, as the lead insurer paid GST on the total premium. So due to that reason, there is no GST here. Next, on whom? On New India Assurance. Second part. That is the second part. Third part. What will be your answer? So the first part is calculate the GST liability. The second part is determine if ICICI Lombard General Insurance is liable to pay. Third part of the question, you see, what will be your answer if New India Assurance is not paying GST on the entire premium of 10 crore, but instead pay GST on the share retained by them? So definitely it amounts to short payment of tax. Why it amounts to short payment of tax? They are required to pay GST on 10 crores. Okay. If New India Assurance is paying GST on 6 crore, then the share of premium received by ICICI Lombard is not excluded from supplying. Because what does the law says? The law says that, here they need to pay GST on 10 crores. If they pay GST on 10 crores, the money received by ICICI Lombard is excluded from supply. Consequently, GST payable by ICICI Lombard on rupees 4 crores. That's what the provision says. But practically what happens here is that, because the provision says if provided that the lead insurer pays the GST on the entire premium paid by the insured. That point is clearly mentioned for that reason. So this condition is clearly given in the law. So therefore, as this proviso they have kept, which means in this case, if the lead insurer is not paying GST on entire amount, not on entire 10 crores, then what will happen? So ICICI Lombard Insurance is not excluded from supply. Consequently, GST is payable by ICICI Lombard on 4 crores. But there is a short payment of tax by this New India Assurance. How there will be short payment of tax? What is the money that they collected? 10 crores. So the transaction value determined under section 15 will be 10 crores. However, in the present case, New India Assurance violated the provision of section 15 by paying GST on 6 crores instead of paying GST on rupees 10 crores. So there is a violation, and this is what we need to just write, that as they have brought in the proviso, we need to see. So look into this Bear Act also. So activity of apportionment of co-insurance premium by the lead insurer to the co-insurer for the insurance service jointly supplied by the lead insurer and the co-insurer to the insured in co-insurance agreements subject to the condition that lead insurer will pay GST, okay, as the case may be, CGST, SGST, UTGST or IGST on the entire amount of premium paid by the insured. As they have kept that provision there, condition there, then only it is excluded. That's why we are arriving at the answer like this. But this note we need to write that New India Assurance is not complying with section 15 because the transaction value should be taken as 1 crore. Okay, here what is that? 10 crores, but instead they are paying GST only on 6 crores. Okay, that is the answer for this question. This is how you may get a question on amendment related to this. Then look into the second part of exclusion. So first exclusion is co-insurance services jointly supplied is excluded. Second one, reinsurance commission. What is this reinsurance commission means? Generally, what happens here? Here there is no concept of co-insurance. Co-insurance is over. There is a concept of reinsurance. Okay, so that reinsurance is what we are trying to understand. Let's see with an example to understand this particular part. There is a insurance company. There is a insurance company 1. There is a insurance company 1. This insurance company 1 or insurance company A, what they are doing is that they are providing the insurance services to the insured. To the insured, they are providing insurance service. Insurance service. But what happened is that this insurance company has too much of risk exposure. So say for example the same 400 crores. Now they wanted to reduce that risk exposure, means if anything happens to the insured, the insurance company A should pay 400 crores. That's a huge risk. So due to that reason, insurance company A will take reinsurance with insurance company B to mitigate that risk, which means insurance company B is providing reinsurance service to insurance company A. Okay. Now, whatever premium that is received by the insurance company A, say for example, they are receiving a premium of 40 lakhs. They are receiving a premium of 40 lakhs. Who? Insurance company A. What insurance company A is doing? They are giving the reinsurance company some premium they are sharing. Say for example, 15 lakhs they are sharing with reinsurance company. Up to this clear? So what happened? Insurance company A received 40 lakhs, insurance company B received 15 lakhs. Now what happens? Simple. Insurance company B will raise invoice on insurance company A for 15 lakhs. So invoice for 15 lakhs, invoice for 15 lakhs, and which they will be able to take ITC, and again insurance company A will raise invoice for 40 lakhs. On insurance company B, no doubt, this is clear. But generally insurance company B is getting this 15 lakhs income they are getting. Normally if they need to get this 15 lakhs, they need to appoint one agent now. Normally if they need to get this 15 lakhs, they need to appoint one agent. So due to that reason, so if they appoint an agent, they need to pay the commission. Am I right? They need to pay the commission. But here insurance company A is bringing them the business. To whom? Insurance company B, means that commission insurance company B has to pay to insurance company A. So insurance company B will give a commission to insurance company A. Will give commission to insurance company A. How much is that commission? Say 1.5 lakhs is given as commission. Got it? On that, insurance company A should pay GST. Correct? So before amendment, what was happening? Let's see. This is the story. Now before amendment, what was happening? Before amendment. So first we will see before amendment what has happened. Before amendment. First, we will take insurance company A. What insurance company A used to do? So they will pay GST on rupees 40 lakhs. That is normal insurance services, insurance premium. So insurance service, normal insurance service 40 lakhs they got. 40 lakhs into 18%, they will pay GST. Okay, so 40 lakhs into 18%, how much that comes to? 40 lakhs into 18%, that is 7,20,000. Thereafter commission also they are getting na, they are receiving commission. So what is that commission that they are getting? 1.5 lakhs they are receiving as commission into 18%. So 1,50,000 into 18%, that comes to 27,000 they are receiving na, so they need to, and this is their gross liability. Gross GST payable, gross GST payable will be 7,20,000 plus 27,000, 7,47,000 minus ITZ. What is the input tax credit? So what is their inward supply? Insurance company B will raise invoice for 15 lakhs na, so that will be ITZ. So 15 lakhs into 18%, they are getting the ITZ. So 15 into 18%, that is 2,70,000. If you reduce the net GST payable, the net GST payable by them will be 7,47,000. 7,47,000 minus 2,70,000, 4,77,000 will be taken as the net GST payable by whom? By insurance company A. Now insurance company B. So insurance company B, what is happening? What is their gross liability? So gross GST payable. The gross GST payable, if you see, so what is the insurance service that they provide? 15 lakhs. On that 15 lakhs, 18% they need to pay, that is 2,70,000, and they will get a ITZ. What ITZ? Commission. Who is paying GST? Insurance company A is paying GST on commission na? So this is an inward supply to insurance company B because they are giving the commission. So therefore on that 15 lakhs they will get ITZ. So ITZ will be 1.5 lakhs. 1.5 lakhs into 18%. 1.5 lakhs into 18%, that is 27,000. So what is that? So 2,70,000 minus 27,000, that will be 2,43,000 will be taken as the GST. What is the total revenue to government? What is the total revenue to government? 4,77,000 plus 2,43,000. 4,77,000 plus 2,43,000, 7,20,000 is the total revenue to government. This is before amendment. This is what we used to do before amendment. Now post amendment, what is happening? Let's try to understand after amendment what is happening. After amendment they are telling the commission which is retained, by whom? Which is retained by insurance company A, GST not payable, which means insurance company A will not pay GST of this 27,000. Okay, so the same situation will come. The same situation will come, but only difference is what? Only difference is that same situation, one second, same situation. Okay, only difference I will tell you after amendment what is happening. After amendment, the insurance company A will not pay GST on this 27,000. So the gross liability will be 7,20,000 minus 2,70,000. So 7,20,000 minus 2,70,000, that will come to 4,50,000. This is in case of insurance company A. But what is not payable? On the commission GST not payable. On the commission GST not payable. Sir, what about insurance company B? Insurance company B will pay GST on the gross amount. There is no question of ITZ. There is no question of ITZ. Insurance company B will pay GST on the gross amount, which means this 2,43,000 will not be there, and just the gross GST payable 2,70,000. Now what is the total revenue to the government? The total revenue to the government is 7,20,000 only. So 4,50,000 plus 2,70,000, that will come to 7,20,000. There is no change in the revenue to government. So what is excluded from supply? On the commission which is retained by the insurance company, GST not payable. On the commission which is retained by the insurance company, GST not payable. So reinsurance commission is excluded from supply. Reinsurance commission is excluded from supply. So have a look into this. Reinsurance commission is excluded from supply. Read this. Services by insurer to reinsurer for which they get a reinsurance commission or ceding commission. In reinsurance agreements, the insurer pay a premium to the reinsurer while deducting a commission. So what is the name of that commission? Ceding commission or reinsurance commission as a part of the arrangement. The proposed insertion clarifies that the provision of these services by the insurer to the reinsurer will not be treated as supply. However, this is subject to the condition that reinsurer discharges GST liability on the gross insurance premium. Sir, what if insurance company B is not paying GST on 15 lakhs into 18%, but they took the ITs, like they have reduced it, means they paid GST only on the net amount. So 15 lakhs minus 1.5 lakhs, 13.5 lakhs. Then in that case, so this particular exclusion from supply is not applicable to insurance company A. That is what is subject to the condition that reinsurer discharges the GST liability on the gross reinsurance premium, which includes the reinsurance commission or ceding commission. Okay. Sir, is it given like that proviso? Yes. Read this. Another point. Services by insurer to reinsurer. What is that? Insurer A to reinsurer for which ceding commission or the reinsurance commission is deducted from the insurance premium paid. They are not going to pay full amount. So 15 lakhs minus 1.5 lakhs, 13.5 lakhs is what they pay. So see here. So how much is the money that they have to remit? They have to remit, 15 lakhs, but already anyhow they need to get a commission of 1.5 lakhs. So effectively they will be remitting 13.5 lakhs. That's what they are trying to convey. Okay. So premium by the insurer to the reinsurer subject to the condition that, here again they gave, subject to the condition that central tax, state tax and integrated tax is paid by the reinsurer on the gross premium payable by the insurer to the reinsurer inclusive of the said commission. Means reinsurer should pay GST on the 15 lakhs even though they effectively receive 13.5 lakhs, but they need to pay GST on 15 lakhs. That is a condition. So that's what I have also simplified, and I have given that provided it's subject to the condition that reinsurer discharges GST liability on the gross insurance premium. So what are the two exclusions from supply that we have seen now? Number one, the co-insurer getting the share of premium from lead insurer is excluded from supply, provided the lead insurer pay GST on the gross amount. Point number two, the reinsurance commission which is received by the or retained by the insurer from reinsurer, okay, which is retained by the insurer, is also excluded from supply provided reinsurer pays GST on the gross amount. Okay. So in simple words you can remember, insurance services jointly supplied is excluded from supply and reinsurance commission is also excluded from supply. Okay. Now related to this reinsurance commission, I gave one illustration. Have a look into this. Question number 2. New India Assurance reinsures a part of its risk with GIC, General Insurance Corporation of India, a domestic reinsurer. The gross reinsurance premium paid by New India Assurance to GIC is rupees 5 crore, but New India Assurance deduct a 20% ceding commission, that is 1 crore, before making the payment. So what is the reinsurance commission? They need to give 5 crore. From 5 crore, 1 crore is the commission they have to get. So 5 minus 1. Okay. So that's what they are doing. GIC is responsible for paying GST on gross premium inclusive of the ceding commission. The applicable rate of GST on insurance and reinsurance is 18%. So what is the first question? The first question is, calculate the GST liability for GIC on the gross insurance premium, reinsurance premium of 5 crore including the ceding commission deduction. So they have to pay GST on gross amount 5 crore. So 5 crore into 18%, that will be 90 lakhs. Next, number 2, calculate the GST liability on New India Assurance on the services provided by them to GIC for which commission is deducted. So on that there is no GST, it is excluded from supply. that commission is excluded from supply. Consequently, GST not payable. Next, number 3. What will be your answer if GIC not paid GST, that is reinsurer not paid GST on gross premium but paid GST on the net premium, means 4 crores, 4 crores, 4 crores, which means the insurer has to pay GST on the commission, which means reinsurer is required to pay GST on the commission. If reinsurance, concentrate, if reinsurer GIC, okay, if reinsurer GIC paid GST on 4 crores, then services by insurer, who is that insurer? New India Assurance, okay, insurer New India Assurance to reinsurer GIC is not excluded from supply. Consequently, GST payable by insurer, so with respect to commission, 1 crore into 18%, 18 lakhs. But the problem is that again here there is a violation. GIC is doing violation. What violation? They have received and they have to pay GST on, so the entire amount. What is that entire amount? 5 crores, but they pay GST only on 4 crores. So they violated the provision of section 15 by not paying on the transaction value. This is the note that we need to write. Okay, that is with respect to this particular amendment. And we have one more question, that is actually a final RTP question. They gave it in RTP for CA final. So we will see that question. ABC Insurance Limited, a registered insurer in Maharashtra, is engaged in providing insurance services. During the current financial year, the company entered into following transactions. ABC Insurance Limited enters into a co-insurance agreement with XYZ Insurance Limited, where ABC Insurance Limited is a lead insurer. ABC is lead insurer. The insured, Gyathi Industries, pays a total premium of 50 lakhs, which is apportioned by the lead insurer ABC Insurance Limited between itself and XYZ Insurance in the ratio of 60:40 for the insurance service jointly supplied by them to Gyathi Industries. ABC Insurance Limited agrees to discharge the entire GST liability on the full amount of premium received from Gyathi Industries. Then in that case, okay, what will be your answer? So that is the first part. Second part also they have given. Now, based on the provisions of Schedule 3, second part we will see later, but based on the provisions of Schedule 3 of CGST Act, discuss whether the following activities amount to supply. Apportionment of co-insurance premium by ABC Insurance to XYZ Insurance Limited for the services jointly supplied by them to Gyathi Industries. No, it is excluded from supply. That is the share of premium received by ABC from XYZ. So, lead insurer. So, insurance activity of apportionment of co-insurance premium by the lead insurer to the co-insurer for insurance service jointly supplied by the lead insurer and the co-insurer to the insured is neither supply of goods nor supply of service, and no GST is charged on the apportionment transaction. However, the lead insurer, what is the important condition? The lead insurer is required to pay entire GST on the full premium amount by the insured, that is Gyathi Industries, of rupees 50 lakhs. The co-insurer XYZ Insurance does not pay GST on its share of premium separately. Got it? Simple question only it is. Then second part. A large industrial plant needs an insurance worth rupees 500 crore. It approaches ABC Insurance Limited for the same. However, since ABC Insurance Limited is unable to underwrite the entire risk alone, it enters into a reinsurance agreement. It enters into a reinsurance agreement with reinsurer PQR Insurance Limited. The total premium charged is 50 lakhs. The insurer ABC Insurance Limited pays a reinsurance premium of 20 lakhs to PQR Insurance Limited. So, how much they are getting? They are getting 50 lakhs. They are sharing 20 lakhs. PQR Insurance Limited. This allows ABC Insurance Limited to manage the risk and financial exposure. While paying this amount to PQR Insurance, ABC Insurance deducts a ceding commission of 1 lakh. What is the treatment of that 1 lakh? It is excluded from supply, but provided that another reinsurer is there, that is PQR, has to pay GST on 20 lakhs. Even though they receive 20 minus 1, 19 lakhs, but they need to pay GST on 20 lakhs. Okay. on which it charged for the service it provides to PQR Insurance Limited. PQR Insurance Limited pays GST on the gross reinsurance premium, including the ceding commission. Now, what is the question here? Services by ABC Insurance to PQR Insurance Limited for which ceding commission is deducted from reinsurance premium paid by ABC to PQR, is it subject to GST? Is it supply or not a supply? For which it is not a supply. That is, yeah, ABC is getting commission of 1 lakh now. On that, are they required to pay GST? No, it is excluded from supply, provided that PQR reinsurer pay GST on the gross reinsurance premium. The reinsurer PQR is liable to pay GST on the gross reinsurance premium, that is 20 lakhs, before this deduction of 1 lakh. Then in that case, that 1 lakh which is earned by the insurer is excluded from supply. Got it? So, services by insurer to reinsurer for which ceding commission is received is excluded from supply. That is about this particular amendment. So, final summary, what you need to remember is that in case of co-insurance, the co-insurer receive premium from the lead insurer which is excluded from supply. Condition: the lead insurer should pay GST on the gross premium. Point number 2. Point number 2, the commission which is earned by the insurer from reinsurer is also excluded from supply, provided the reinsurer pays GST on the gross premium which they have received. Okay, these are the 2 points you need to keep in mind. Now we are moving on to the next amendment, that is related to the penal charges being levied by the regulated entities. Now let's try to understand some background related to this. Already there was one circular which talks about liquidated damages. So liquidated damages, how it should be treated. Liquidated damages will be first divided into mere compensation. Liquidated damages means what? So some amount which is collected by the person so who suffers the breach of contract and from the person who breaches the contract. For example, if you breach the contract, you will be giving me liquidated damages because I suffer the damages. Okay, some money you will be giving me. If that is compensatory nature means what? There is no possibility of performance. There is no possibility of performance. I suffered and for which you are just giving me to relieve me from that suffering. But of course, the possibility is not there. Then it will be coming under compensatory nature. For example, say we are driving a car. When we are driving a car and we hit one person and that person is dead. Now the court will tell you pay 20 lakhs compensation. That 20 lakhs compensation will be not coming under possibility of performance, that is compensatory nature. Then the contract is abruptly stopped. When the contract is stopped, not that it is provided but late, no, not that, it is completely stopped. In that case also it will be compensatory in nature and it will not be treated as consideration, the money received. Suppose if it is penal in nature, to discourage a person from doing such act. Example, traffic fines, then fines and penalties under any law, that is income tax penalty or GST penalty, etc. And even we have this check dishonor charges. All these are penal in nature. To discourage a person from doing it, then it will be coming under consideration or not treated as consideration. That is also not treated as consideration. Consequently, it is not a supply. All others other than compensatory in nature, other than penal in nature, remaining and all will be treated as consideration, but the taxability is dependent on the taxability of its principal supply. For example, train ticket cancellation charges. Train ticket cancellation charges will be taxable if the train ticket is taxable. If the train ticket is exempted, the ticket cancellation charges is also exempted. Why won't ticket cancellation charges come under compensatory nature? It is not compensatory nature because the ticket they can sell it to some other person also. Number 2, so is it penal in nature to discourage a person? No. If he is not traveling, let it cancel so that that seat can be allotted to some other person. So it is not to discourage the person from doing such act. So therefore it will be coming under others. This is the circular which was already there. Now what is this circular about? Generally, these banks, financial institutions, NBFCs, etc. and all, when you are not repaying the EMI, they will be levying something called as penal interest. But RBI recently gave a circular stating that the banks, financial institutions and NBFCs, that is regulated entities, should not be collecting penal interest. Instead, they should call it as penal charges. Instead, they should call it as penal charges. See this. As per RBI instructions dated 18/8/2023, regulated entities, who are those regulated entities? Like banks and NBFCs must replace penal interest with penal charges for non-compliance with loan terms effective from 1/1/2024. These instructions do not apply to credit cards, external commercial borrowings, trade credits or structured obligations. But this is only for loans, not for credit cards, not for ECB, trade credit, etc. It is only for normal loans. So this particular circular is not applicable for credit card. Then for credit cards, still they can levy penal interest? Yes. And will it be taxable? Of course, yes. Why penal interest will be taxable? Because the interest on credit card is taxable, so penal interest is also taxable. Remember this. If the interest involved in EMI is taxable, penal interest is also taxable. If the interest involved in EMI is exempted, penal interest is also exempted. This is the concept of penal interest. For credit card, still penal interest is only there. The intent of penal charges is to promote credit discipline and not to treat them as consideration for tolerating an act. So, which means the intention is what? To discourage a person from doing it. Referring to earlier circular on liquidated damages, one old circular, CBIC clarifies that such penal charges are for breach of contract and it is not treated as consideration. Why it is not treated as consideration? Because the same is to discourage a person from doing so. Okay, penal in nature. And therefore it will not be liable to GST. So that is a treatment of penal charges. What if it is penal interest? Penal interest means definitely if the main interest involved is taxable, penal interest is also taxable. Main interest involved is exempted, penal interest is also exempted. Got it? And when main interest will be exempted taxable? If it is interest on loans, advances, deposits, it will be exempted. If it is interest on account of delay in receipt of consideration, then it will be taxable. Like that we need to treat. Okay. Now, look into this. Question number 4. Mr. Rahul Mehra availed a car loan of rupees 12 lakh from HDFC Bank Limited on 10th January 2024. The loan agreement clearly specified that timely EMI payment on 5th of every month was a material term. Rahul defaulted on his EMI for April and May 2024 as per RBI circular dated 18/8/2023. HDFC Bank levied a penal charge, not penal interest, penal charge of 1,500 per default instead of penal interest. On 10th June, the bank raised a debit note for 3,000, that is 1,500 into 2 months, and charged 18% GST on the penal charges. Simultaneously, Rahul also holds a credit card with Bajaj Finance Limited. He delayed the credit card bill payment due on 15th May, for which Bajaj Finance levied a late payment charge of 750 along with 18% GST. Citing it as a standard practice for credit card dues. Rahul has now approached you as his GST consultant to understand whether HDFC Bank is correct in charging GST on penal charges levied for loan EMI default. No. Why? Because penal charges are in the nature of penalty to discourage a person from doing it, so to maintain the credit discipline. So these penal charges are treated as consideration or not treated as consideration, not treated as consideration. Consequently, GST is not payable. HDFC Bank is an RBI regulated entity and the default loan is a car loan, a standard term loan falling under RBI circular. So penal charges are levied in the place of penal interest. As clarified by CBIC, these charges are not for tolerating an act but are deterrent in nature and part of loan compliance framework. Hence, HDFC Bank is incorrect in charging GST on penal charges of 3000 rupees. Okay, sir. What about the late payment charges collected by Bajaj Finance on credit card? This particular RBI circular is not applicable for credit cards, correct? Not applicable for credit cards. Credit card dues are explicitly excluded from the purview of RBI circular. Such charges are typically included in the product specific guidelines under credit card operations, where CBIC in some earlier clarification clarified that late payment charges on credit card dues are treated as supply. Why? I told you, as the interest involved in credit card is taxable, the interest, late fee, penalty for delay in receipt of credit card is also taxable. That late payment charges on credit card dues are consideration for supply of financial service and hence liable to GST. Circular on liquidated damages is not applied in this case. Sir, here also it is penal in nature, na sir? Correct. But there is another circular which says that, so penal charges, that is late fee or interest on credit card, will be taxable like that. Another circular is there. That's why this circular on liquidated damages is not applied. Therefore, GST is applicable on late payment charges related to credit card dues, and Bajaj Finance is correct in charging GST on 750. So keep that in mind. That particular liquidated damages circular is not applicable, even though here that late payment charges may be there, but because there is another circular which clearly clarified that credit card late fee will always be taxable. Interest, late fee or penalty for delay in receipt of credit card dues will be taxable. Keep that in mind. Okay. So like this they can connect the points and they can make a question. Okay. The next amendment that we are going to see is related to liability to pay GST. In this, so we have RCM, we know that section 9 subsection 3 read with notification 13/2017, we have some list of activities, list of services which are covered under RCM. In that, renting of immobile property, what was the provision? Renting of immobile property, previously we had some exemptions. So if it is a residential property, we have 3 exemptions for residential property, that is renting of residential property for residential purpose to an unregistered person is exempted. Renting of residential property for residential purpose to a registered individual for his family stay, for their family stay, that person individual's family stay is exempted. Number 3, accommodation services where the consideration does not exceed 20,000 rupees per month and accommodation is given for a continuous period of 90 days. This accommodation point is common even for commercial property also. For commercial property also we have this exemption of accommodation services. So whenever there is a property, that may be a residential property or a commercial property, which is being given on accommodation for a continuous period of 90 days, minimum continuous period of 90 days means greater than or equals to 90 days, where the value is less than or equals to 20,000 per month is exempted. This is the exemption, no change in that. But there is a change in the condition for RCM. For commercial property, when RCM will be applicable, if the supplier is unregistered and the recipient is registered, it will come under RCM. This was the condition before amendment. Before this amendment, previously for renting of commercial property, when it will come under RCM, supplier should be unregistered, the recipient should be registered, then it will be RCM. Now they added one point, supplier should be unregistered, recipient should be registered, but not opting for composition scheme. What if the recipient is registered but opting for composition scheme? RCM will not be applicable. Okay, so say this, supplier should be unregistered, that's the first point, and recipient should be registered but not opting for composition scheme. What if the recipient is opting for composition scheme? If the recipient is opting for composition scheme, then FCM only will be applicable, RCM will not be applicable. So what is that? First we need to check. See the flow chart. So the flow chart will be simple here. So first, what is that you need to check? Is it renting of immobile property or not? We need to check. Okay. So is it renting of commercial property? Is it renting of commercial property? Renting of commercial property. Renting of commercial property. Okay. After that, renting of commercial property, we need to check how the supplier is. Is the supplier registered or unregistered? We need to check. Okay. So supplier is registered. Supplier is registered. If it is yes or no, supplier is registered. Yes, supplier is registered. Don't check anything. If it is not, okay, renting of commercial property, if taxable, if taxable, if taxable. If it is exempted, then we will not discuss this. If taxable. So what is the exemption? Just now we saw accommodation service. Supplier is registered, yes. Then who will pay GST? FCM. Supplier only will pay GST. Don't check anything else. Don't check anything else. Supplier only will pay GST. If supplier is not registered, okay, if it is no, supplier is registered, no, means not registered, then check whether recipient is registered. Recipient is registered. This is also, no. This is also no. Supplier is also unregistered. Recipient also unregistered. Definitely there is no GST. Why there is no GST? Because both are unregistered na. Supplier is also unregistered, recipient also unregistered. Definitely there won't be any GST between two unregistered persons. If there is a transaction, GST will not be applicable. So no GST. Yes, recipient is registered. Recipient is registered. What we used to do before, we used to take it as RCM. But now, one more point you need to check. What is that one more point that you need to check? Registered, but is he under composition scheme? Recipient under composition scheme. Recipient under composition scheme. Okay. Suppose if it is yes. Suppose if it is yes, then RCM will not come, FCM only. So actually here also it is FCM. Previous case na. Supplier is not registered pa. Recipient is also not registered, means RCM will not come. If RCM is not applicable, then FCM, but no GST. Charge is FCM. Charge is FCM, but GST not payable. Why not payable? Because the supplier is not registered. Same way here also, whether the recipient is under composition scheme, recipient is registered, but whether they are under composition scheme, yes, then also FCM, means RCM will not come. But there is no GST. Why there is no GST? Because supplier is unregistered. But in the first case, GST payable. Why first case GST payable? That is first case of FCM. Why GST payable? Because the supplier is registered. Okay. Again I am repeating. Renting of residential property, that is commercial property. If supplier is registered, no doubt, supplier only will pay GST. If supplier is not registered, then check whether recipient is registered. No. Then also it will be FCM. Whether GST payable or not payable because the supplier is unregistered. RCM not applicable because the recipient is registered. Okay. Then again check whether the recipient is under composition scheme. Yes. Then also RCM not applicable, it is FCM because the recipient should not opt for composition scheme, but there won't be any GST. Why there is no GST? Because the supplier is unregistered. It is coming under FCM, but the supplier is unregistered. So now recipient is under composition scheme. No. Supplier is unregistered, recipient is registered and not under composition scheme, then it will be RCM, where liability to pay GST is on recipient. So this is what you need to keep in mind. Okay. So what are the two conditions for commercial property coming under RCM? Supplier should be unregistered, recipient should be registered but not opting for composition scheme. If supplier is registered, always FCM. If recipient is under composition scheme also, it will be FCM only. RCM will not be applicable. That is what I have given there. So non-applicability of RCM, supplier is registered or recipient is opting for composition scheme. Then next, yes, for sponsorship services. In case of sponsorship services, what we have studied, we have exemption for sponsorship. One exemption. What is that? That is sponsorship of a recognized sporting event is exempted. Correct? Sponsorship of a recognized sporting event. What is a recognized sporting event? So there are 6 sporting events: National Sports Federation, Inter-University Sports Body, and then Paralympic Committee, Central Civil Services Cultural and Sports Board, then Indian Olympic Association, Panchayat Sports Board. These are the 6 recognized sports bodies. If the sponsorship money is collected by them, it will be exempted. Otherwise, it will be taxable. And what are the conditions for RCM? We studied already. Supplier, that is recipient, should be body, corporate or firm. For sponsorship services, supplier is the organizer of event. Recipient should be body, corporate or firm. That is the one who pay the sponsorship money is body, corporate or firm. Then it will be coming under RCM. But now what is the amendment? The amendment is that supplier should be other than body corporate. They added this point. Previously only recipient should be body corporate or firm, but now they added one point. Supplier should be other than body corporate or firm. See this. Supplier is other than body corporate, not firm. Supplier is other than body corporate. Supplier can be firm, supplier can be individual, supplier can be AOP, supplier can be BOI, but they should be other than body corporate. And recipient is body corporate or firm, then only it will be coming under RCM. What if supplier is body corporate? Supplier only will pay GST. You got it? So for example, if a company is organizing an event, the company only will pay GST. So if the supplier, that is organizer, is other than body corporate, then only we need to check the recipient. Okay. What if supplier is body corporate? By default it will be FCM. So if recipient is other than body corporate or firm, also it will be FCM. So the same way, that flowchart we will see for sponsorship services. This is for renting of immobile commercial property. Now we will see for sponsorship services what should be taken. Okay. So first, for sponsorship services, so in case of sponsorship services, we need to see, and provided if taxable, if taxable, what is that? First you need to see. Supplier is body corporate. Supplier is body corporate. Supplier is body corporate. If the answer is yes, supplier is body corporate, then FCM, definitely FCM. Supplier is body corporate. Who is the supplier pa? The supplier will be nothing but the organizer of the event. Organizer of the event will be taken as the supplier, correct? And supplier is body corporate means it will always be FCM. Suppose if it is no, supplier is not body corporate, then check the recipient. Is recipient is body corporate or firm? Recipient is body corporate or firm? Recipient is body corporate or firm? If it is yes, recipient is body corporate or firm, yes, then who will pay? RCM. It will come under RCM. Okay. Suppose if it is no, recipient is not body corporate or firm, supplier is not body corporate, recipient also not body corporate or firm, then also it will be coming under FCM. Supplier only will pay. Suppose supplier is not body corporate, recipient, supplier is not body corporate, so we are checking. Recipient also is body corporate or firm. Okay, then it will be RCM. Just check this. Okay, what is it we need to see? First check whether supplier is a body corporate or not. Yes, supplier is a body corporate, definitely it will be coming under FCM. Supplier is other than body corporate, then we need to check whether recipient is body corporate or firm. No, then it is FCM only. Suppose if the recipient is body corporate or firm, then it will be coming under RCM. So that's how we need to determine. Is it clear? Next, so that's what I have given here. So condition, non-applicability of RCM, supplier is body corporate or recipient is other than body corporate or firm. Now look into some questions based on this. Question number 1. Who is liable to pay GST in the following scenarios in case of sponsorship services? Mr. Ramesh, an unregistered individual. It is sponsorship services. Okay, Ramesh is an unregistered individual, supplier other than body corporate, let out his commercial shop. Okay, actually it is not sponsorship, it is renting of immobile property. Sorry. So in case of renting of commercial property, renting services, in case of renting services, Mr. Ramesh lets out his commercial shop to Sky Retail Private Limited. So supplier is unregistered and recipient is registered on a monthly rent of 25,000. Will it come under RCM? Of course it will come under RCM. Why it will come under RCM? Because supplier is unregistered and the recipient is registered but not under composition scheme. Next, number 2. Suresh is a registered individual, lets out his commercial property to Messrs. Tej Foods, a restaurant registered under composition scheme for a monthly rent of 40,000, definitely FCM. Why? Supplier is registered. When supplier is registered, don't check anything else. Supplier is registered, definitely it will be FCM. Next, number 3, Mr. Rajesh, unregistered individual, lets out his commercial complex to Messrs. A1 Mobiles, a trader registered under composition scheme. Now, in this case, who will be paying GST? So, supplier unregistered. Recipient is registered but opting for composition scheme. It will be FCM only, but there is no GST. Why there is no GST? Because the supplier is unregistered. Supplier is unregistered, recipient is registered, and the recipient is opting for composition scheme. Then in that case it will be FCM, RCM not applicable, but as supplier is not registered, you should write GST not payable. That's how we need to arrive at the answer. Okay. Look into question number 2. Who is liable to pay GST in the following scenarios in case of sponsorship services? So for sponsorship services, Tata Steel Limited sponsors a sports event organized by Green City NGO. Who is supplier? The one who is organizing is the supplier pa. The one who is organizing. So this Green City NGO is the supplier. Registered as a society but not as a body corporate. Registered as a society but not as a body corporate, means supplier is other than body corporate. And the recipient is Tata Steel Limited, which is a body corporate. Recipient is a body corporate. As recipient is a body corporate, it will definitely be coming under RCM, because supplier is other than body corporate, recipient is body corporate or firm. Okay. So this is as per amendment. Next, second case, ABC Private Limited, a registered partnership firm, is the recipient of sponsorship benefit and brand display with respect to event hosted by Paper Mills Limited. So event hosted by Paper Mills Limited means the supplier, the one who is hosting the event. Paper Mills Limited is the supplier. Supplier is body corporate. So definitely it will be FCM. As supplier is body corporate, no need to see further. It will be coming under FCM. Okay. As supplier of sponsorship service is body corporate, RCM not applicable and it will be FCM. And recipient can be anyone. So basically ABC Private Limited, a registered entity is the recipient of sponsorship services. Then Regal Foundation of Commerce organized a business summit in Surat, Gujarat, in which all the startups were invited to pitch their business ideas. Pandit Jewels Private Limited, registered in the state of Maharashtra, sponsored the summit and paid a sponsorship fee of 1,50,000 to Regal Foundation of Commerce. You are required to determine who is the person liable to pay tax if Regal Foundation of Commerce is a body corporate. Regal Foundation is the organizer, means they are the supplier. As the supplier is body corporate, it will be coming under FCM. What if they are not a body corporate? If they are not a body corporate, see the recipient. So who is the recipient? Pandit Jewels Private Limited, body corporate. So therefore it will be coming under RCM. Supplier other than body corporate, recipient is body corporate or firm. Okay, firm means partnership firm, includes LLP. So first case, in case of service provided by way of sponsorship service to any body corporate or partnership firm by any person other than body corporate, the recipient is liable to pay under reverse charge. Since Regal Foundation is body corporate, reverse charge not applicable, so therefore it will be forward charge. In case of service provided by way of sponsorship to any body corporate or partnership firm by other than body corporate is coming under RCM, since they are other than body corporate and the recipient Pandit Jewelers is body corporate, so it will come under RCM. So that is in case of this RCM with respect to renting of commercial property and sponsorship services. Keep this in mind. Apart from that, all other RCM will be normal. These two place only slight amendment is there. So we are moving on to the next amendment here, that is clarification in respect of input tax credit availed by e-commerce operator where services are notified under section 9(5) of the CGST Act. Basically here, whenever the services are supplied through e-commerce operator, that is under 9(5), the liability to pay GST is on e-commerce operator. What are those services? HATE, H for housekeeping services, A for accommodation services, T for transportation of passengers through any motor vehicle, E for eating food in a restaurant. As per 9.5, when e-commerce operator is liable to pay GST, how they will be paying GST? Through credit ledger or cash ledger, because they will have some input tax credit. What are the inward supplies of e-commerce operator? We have platform, so they have to buy the platform, and they need to buy the server space, and they need to receive the advertising services and technology development services. Lot of inward supplies will be there for e-commerce operator. So with respect to those inward supplies, they will have ITC, and can they utilize that ITC for payment of GST under 9.5? Before this amendment, they can use input tax credit for payment of GST for HAT, housekeeping service, accommodation service and transportation service, but for eating food in restaurant, they cannot use ITC. They have to pay through electronic cash ledger only. That was the amendment before amendment. So before amendment, they can use both credit ledger and cash ledger, like that we had for few services, but for restaurant only, eating food through restaurant service only, they have to pay through cash ledger. But now CBIC gave a clarification that for all 4 services, 9.5, all 4 services, 4 notified services supplied through e-commerce operator, the liability to pay GST is on e-commerce operator. They cannot use input tax credit, means they have to pay only using cash ledger. Then what they can do with respect to that input tax credit? They will have some other liability na. What is that some other liability? If they provide any other service through their platform or delivery charges, etc., on that they can pay GST and use the input tax credit. For example, you take Swiggy. Swiggy will supply food and will also do the Instamart. For supply of food, on food they need to pay GST, but on Instamart they will not pay GST on the goods. On goods, supplier will pay GST. They will pay GST only on the commission. So carefully listen. So what we are trying to understand is that Swiggy will make 2 different supplies. Swiggy will make 2 different supplies to the customers. So what is that? There is supplier A, who supplies the food, through Swiggy platform, okay, who supplies food through Swiggy platform to the customer, correct? Now in this case, for this food, who is liable to pay GST? Swiggy is liable to pay GST. So which means invoice is raised by, for this food, the invoice will be raised by, okay, who will raise the invoice for this food? Swiggy will raise the invoice. Swiggy will raise the invoice because GST is payable by Swiggy. Then there is supplier B. And supplier B will be making supply of some goods, Instamart, okay, food Instamart orders. So normal commodities and all they will be supplying to the customer. Now in this case, who will pay GST? Supplier only will pay GST, so they will raise invoice to the customer. Got it? Supplier only will pay GST, so they will raise invoice to the customer. Then what is the benefit to this? On this for Swiggy, they get commission. On that commission, Swiggy will pay GST. Is it clear? So what is the liability on Swiggy? What is the liability on Swiggy? They have 2 liabilities. GST on food, okay, plus GST on commission with respect to sale of goods. So whenever they are selling the goods through their platform, they get the commission, and on that they need to pay GST. Now listen. So this GST on food is covered under section 9.5, correct? This GST on food is covered under section 9.5 liability, but this will be normal liability. Now here, sir, can they use ITC for payment of GST on food? No. So this has to be paid. This GST on food is there na, that has to be paid only through cash ledger. So this 9.5 liability only through cash ledger, only through cash ledger. Whereas this GST on commission normal liability is there na, that is through cash ledger or credit ledger. They can use them both. They can use both credit ledger as well as cash ledger for making payment of this normal liability. But that 9.5 liability alone, they have to pay using cash ledger. Credit ledger not possible. Okay. So that's what is given here. E-commerce operators may pay tax under 9.5 for notified services, that is HAT, housekeeping service, accommodation service, transportation of passenger service and eating food from the restaurant, as if they are the supplier. Provide own services like platform access, commission, listing fee, etc., for which they charge users and pay tax under normal forward charge. The issue here is whether the e-commerce operator is required to reverse the proportionate ITC on inputs and input service used commonly for their own taxable services and section 9.5 supplies. No, they don't have to apportion. Whether ITC available to e-commerce operator be utilized for payment of GST under 9.5. These are the two issues for which they gave a clarification. Clarification number 1, no reversal is required. No reversal is required. That is, with respect to this GST on food, they are paying GST on food, whereas for commission only they pay not on sale of goods. Then how can they take entire credit? Nothing of that sort. They can take entire credit. They can take entire credit. All inward supplies they will be able to take ITC. No reversal of ITC is required under 17.1 or 17.2 just because e-commerce operator is paying tax under 9.5. However, the ITC cannot be utilized for payment of tax under 9.5. Then how that 9.5 tax should be paid? That tax must be paid only through cash. Earlier this condition was only for restaurant service through e-commerce operator, but now it is extended to all notified services through e-commerce operator. And the ITC whatever they have, they don't have to reverse. That can be utilized for payment of their own supplies, the commission, listing fee, etc. and all other things are there now on that. So for that they can use. The ITC can still be utilized for payment of GST liability on e-commerce operator own service. What if they are not able to utilize, they have excess credit? That excess credit will be carried forward. And there is no time limit now for utilization of credit. For availment only there is a time limit. But for utilization there is no time limit, so they can carry forward and adjust against the liability whenever they get the liability in future. At that time they can adjust with that. That is this clarification. And say this, e-commerce operator providing services, supplies notified under section 9.5, pay tax fully in cash, cannot use ITC. With respect to own services, that is platform fee, commission, etc., can use ITC to pay tax on such taxable supplies. No reversal of ITC required on inputs or input services used. Now, I have given one question based on this. Urban Stay Private Limited is an e-commerce operator facilitating short-term accommodation services through its platform, a notified service under 9.5 of CGST Act. In the month of April 2025, it had the following transactions. Outward supplies, if you see, booking charges for home stays provided by unregistered persons through the platform, platform usage fee charged to property owners, commission, advertising space sold on the website to brands. Okay, so these are the three things. Booking charges for home stays. So booking charges for home stays provided by unregistered persons through the platform. So in case of accommodation services, and housekeeping services, H&A, for H&A, remember H&A, housekeeping service and accommodation services will come under 9.5 only if the supplier is unregistered. So this is accommodation service, correct? Booking charges for home stays provided by unregistered persons through the platform, which means that liability to pay GST is on Urban Stay, not on the supplier. Because for H&A, housekeeping and accommodation, if the supplier is unregistered, the liability to pay GST is on e-commerce operator. Accordingly, e-commerce operator will pay. This is under 9.5. So this liability will be under 9.5. Platform usage fee charged to like property owners, this is another transaction, separate transaction, commission, this is normal liability. And advertising space sold on website to brands, that is also their normal liability. Now for this 10 lakhs into 12%, that is 10 lakhs into 12% is what, 1,20,000. They have to pay only through cash ledger, they cannot use ITZ. But for this 2 lakh and 1 lakh, 3 lakhs into 18%, they can use ITZ for payment. Now they have got some inverse supplies. Google ads and marketing services. Can they take ITZ? Yes. We don't have that in blocked credit and it is used in the course or furtherance of business. Therefore, ITZ is available in this case. Office rent, commercial property also, they can take ITZ. Laptop purchase for marketing team also, they can take ITZ. But food and beverages is blocked credit. They cannot take ITZ. Why? Food and beverages is blocked credit, but we have exception. What? Inward supply, outward supply in the same category? No. Inward, outward not in the same category because food and catering for in-house training. So no. And inward supply is part of outward supply. Then also it is not covered here. It is available, but it is not covered here. Statutory obligation not covered here. That's why ITZ not available. Cloud server subscription, ITZ can be taken. Okay. Next. So therefore, in this case, what happens is that they will be able to take the ITZ. How much ITZ they will be able to take? Say this. 1 lakh into 18%, 18,000. 70,000 into 18%, 12,600. 1 lakh 20 into 18%, 21,600. 20,000 into 5%, they cannot take. That they cannot take. And 60,000 into 18%, 10,800. Total 63,000 they can take as ITZ. Got it? Now, what is their normal liability? 3 lakhs into 18%. 3 lakhs into 18%, that is 54,000. So, 2 lakhs into 18, 1 lakh into 18, 3 lakhs into 18%, 54,000. Now, this 63,000 can be utilized for payment of 54,000. How much credit? 63,000. Fully they can utilize for 54,000. The remaining amount of credit, can they use for payment of this 1,20,000? No, that has to be paid by cash only. So, which means 63 minus 54, still 9,000 rupees is there. That 9,000 is the balance ITZ to be carried forward. That balance ITZ to be carried forward will be 9,000. And what about this remaining, I mean like ITZ carried forward, but 1,20,000 has to be paid. So, what is the total tax payable? 1,74,000, 1,20,000 plus 54, 1,74,000, but we can utilize only ITZ 54. So, remaining 1,20,000 we have to pay only by cash because it is 9,500 liability. What is the balance ITZ to be carried forward? 9,000. Okay. Again in future whenever they have liability, with that liability they can set off. That's how we need to arrive at the answer for this. Now we are moving on to the next amendment, that is whether DDA, Delhi Development Authority, is local authority or not a local authority. What is the background? Generally, services provided by government to business entity is covered under RCM. What is the meaning of government? Central government, state government, local authority will be coming under government, and if they provide service to a business entity, it is covered under RCM. Delhi Development Authority provided some services to some business entities for which they collected some money, and a confusion came as to whether it is covered under RCM or not. But the Delhi Development Authority's argument is that first of all it is exempted. Where from RCM it is exempted? Because we are government authority. That is their argument. We are government authority and any service provided by government authority will be exempted. So we will come under government authority, but GST department is saying no, you are local authority. Finally, a clarification has been provided. What is the difference between government authority and local authority? Government authority means a body or board or authority which is established under an act of parliament or state legislature, or a board or body in which government has invested greater than or equals to 90%. 2 points. Established under an act of parliament or state legislature, or in which the government has invested greater than or equals to 90%. And their purpose is to carry out the functions under the constitution, article 243G or 243W of the constitution. Then it is called as a government authority. whereas local authority is completely different, which is under state government, which take care of the welfare of the people of that particular locality using the fund, municipal fund or panchayat fund, etc. That is called as a local authority. That is completely part and parcel of government. So Delhi Development Authority is basically not a local authority, it is a development authority, urban development authority, that will come under, government authority. It's not a local authority, okay, as the same is not an elected municipal body. Usually service provided by local authority to business entity is covered under RCM as per 9(3) Red with notification. As DDA, Delhi Development Authority, is not a local authority, their services will not come under RCM. However, they fall under governmental authority as they are set up under an act of parliament to carry out functions under the constitution, article 243W. Urban development will come under that. So generally we have an exemption that any service provided by government authority will be exempted. Any service provided by government authority is exempted, and consequently services provided by this Delhi Development Authority is also exempted. Now look into this question, how this can be tested in exam. Skyline Constructions Private Limited, a registered real estate developer in Delhi, enters into a lease agreement with Delhi Development Authority in April 2025 for acquiring a plot of land on long-term lease for commercial development. And Delhi Development Authority raised an invoice of 50 lakhs as upfront lease premium. But sir, we have an exemption, sir, upfront lease amount is exempted, like that one point is there. That is lease of land by SIDCO, State Government Industrial Development Corporation. But here Delhi Development Authority, anyhow government authority services will be exempted, let it be upfront premium or whatever it may be. Skyline Constructions intended not to pay GST under RCM, claiming that since DDA is a local authority and the services fall under serial number 5 and hence RCM applies. So basically they enter into lease agreement for acquiring a plot of land. However, the jurisdictional officer contends that DDA is not a local authority under section 269 and demands GST payment under forward charge by DDA. So basically, they enter into a lease agreement with Delhi Development Corporation for acquiring a plot of land. So basically Delhi Development Corporation is the supplier which is giving the plot of land to Skyline Constructions. Okay. So, but the officer is telling it will come under forward charge, Delhi Development Authority has to pay GST. Justify your answer with the legal provision. Basically, Delhi Development Authority is not a local authority, that is correct. Whatever the jurisdictional officer is contending is correct, but GST payment will not arise. Okay. It does not qualify as local authority. Therefore, RCM, which applies only to service provided by local authority to business entity, not applicable in this case. However, DDA qualify as government authority since it is a statutory body under Delhi Development Act and it is eligible for exemption. Therefore, there is no GST liability either under reverse charge or under forward charge. The officer's contention is not correct. The officer is telling that it is forward charge, that is also not correct. Reverse charge also not correct because there is no GST payable. The contention of jurisdictional officer is not correct. So this is related to that question, Delhi Development Authority point, how they can test in exam. I gave all the questions on amendments in order to understand its application, okay, but you remember the amendment, that is sufficient. So don't see this many pages are there, this much time is there, etc. and all. Finally, what you need to remember is only the amendment, what it is. So now we are moving on to the next area, that is levy and collection under IGST. In this, there is one amendment related to section 16, that is zero rated supply. Section 16 of IGST Act says that whenever there is a zero rated supply of goods or services, that is export of goods or services or supply of goods or services to SEZ, we have two options. What are the two options? Pay IGST and get refund of that IGST, gross IGST, or don't pay IGST, export it under bond or LUT and get refund of unutilized ITZ, correct? Now, in these two options, previously, that is before this amendment, if the export of goods is upon payment of customs duty, then only option 2 is possible, option 1 is possible, option 2 is not possible. That is, you can pay upon IGST, you can export upon payment of IGST and you can get the refund of gross IGST. That was the situation. Option 2, refund of unutilized ITC, was not available when before amendment. Before amendment it was not available. Now what they are telling, both options not available, neither option 1 nor option 2. Whenever you are exporting goods upon payment of customs duty, say this: no refund of unutilized ITC or refund of IGST paid on zero rated supplies. No refund of unutilized ITC, no refund of unutilized ITC or refund of IGST paid on zero rated supplies will be allowed if goods are subject to export duty. So neither option 1 nor option 2. Okay, and this point is there even in refunds chapter also. Apart from that, one more amendment is that previously certain notified class of goods, they will not be able to claim refund, like pan masala, tobacco and tobacco products, essential oils other than those of citrus fruit, like that. But not only the class of goods but also class of suppliers may not be able to claim the refund. So the government on recommendations of GST Council can issue notifications specifying class of persons who are allowed to make zero rated supplies on payment of IGST. So who are allowed to pay IGST and get refund? Class of persons, class of goods or services can be notified. Okay, so not only class of goods or services but even the class of persons can also be notified in this regard. Means for them only pay IGST and get refund of IGST option will be available. Okay, right now for everyone other than exporters who are exporting pan masala, tobacco and tobacco products, essential oils other than those of citrus fruit are notified, for which both the options are available. But once you are exporting upon payment of customs duty, neither option 1 nor option 2. Now see this, question number 1. Vasudha Agro Exports Private Limited, registered person in Madhya Pradesh, is engaged in export of various agricultural products including raw cotton HSN 5201 and refined rice HSN 1006 for the month of November 2024. Vasudha undertakes the following exports: raw cotton 1.2 crores, export with payment of IGST. Raw cotton attracts export duty of 10%. So in this case we will never get refund. We will neither get refund under option 1, that is pay IGST get refund, nor option 2, which means it is a deemed interstate supply and we need to pay IGST. As per newly inserted section, no refund is available. Raw cotton attracts 10% export duty, refund claim of 18 lakhs, IGST paid on export will be denied. Means whatever IGST you pay. Why you need to pay? Because it's a deemed interstate supply, so you need to pay. Whatever IGST you pay is what you have paid, that's it. You will not get any refund. Then refined rice. Refined rice 1.5 crore, export under LUT without payment of IGST, it is not subject to export duty. Yes, so as it is under LUT, you will be able to claim the refund of ITC. Export or refund rice continues to be covered under zero rated since it is not subject to export duty, and section 16.5 applies only when export duty is applicable. Refund of accumulated ITC is eligible in this case. Third, refined rice 50 lakhs, export with payment of IGST option. They are going for export with payment of IGST option. Is refined rice covered in the list of notified goods? No. So although 16.4 empowers government to notify restricted class of persons or goods who cannot export on payment of IGST, as of now only following are notified, that is pan masala, tobacco and tobacco products, essential oils other than those of citrus fruit. Since refined oil is not in the list of notified goods, they can export and upon payment of IGST, and whatever IGST they paid, they will be able to claim the refund. The company applies for refund of 18 lakhs of IGST paid on raw cotton and 6 lakhs of IGST paid on refined rice. No, 18 lakhs will not be available, but 6 lakhs will be available. They also apply for refund of accumulated ITC on input service used in LUT based exports of rice. Explain whether refund is available in the following cases. Yes, since first case refund not available, second case and third case refund is available. So that is what we need to write. Okay, just 2 points you need to remember. What are those 2 points? That is export upon payment of customs duty. You will neither get option 1 nor option 2. Also option 1 is now available only for notified class of goods and notified class of persons. Who are those notified class of goods or persons? Everyone. Right now everyone other than, so supplier of notified goods, that is pan masala, tobacco and tobacco products, essential oils other than those of citrus fruit. Now we are moving on to exemptions under GST. In this exemptions under GST there is one section, that is section 11A of CGST Act. Whatever is there in 11, the common section for IGST Act is section 6. Section 6A of IGST Act, 11A of CGST Act. That is power not to levy GST as a past general practice. I will give you little background related to this. Say suddenly government is bringing a particular transaction into the taxability. In the past, from 2017, people have not paid GST on the transaction. Now suddenly when GST department, that when government brings in the taxability of this transaction, people will not accept to this. Can the people protest, and whether the government has power to roll back, or should it take parliament approval? To bring a point into the taxability, they need parliament approval, because they need to present it in the Finance Act and they need a parliament approval, and then the amendment will come into place. But when to roll back, to remove it, then logically we need to take parliament approval, but for that reason they are telling again no need to wait for the parliament approval. The government can by way of notification itself do so. Example, on jewelry the rate of GST is 3%. So because gold rate is 3%, so on jewelry also it will be 3%. But now say, if Finance Act 2025, they may come out with one amendment stating that only on the metal involved in the jewelry only it will be 3%, but on the making charges 18% is payable. Because in jewelry there are two parts, one is metal value, another is making charges. Then on making charges GST will be 18%, on metal it will be 3%, like that. One change has been brought, for example. But so far people were not accustomed to paying it, people were paying only 3%. Now can the people make a protest? Yes, jewelry shops and people, everyone can make a protest. Because of which, whether again next Finance Act 2026 only they will take the decision to remove it, or immediately whether the government has power to remove, immediately the government has power to remove. No need to wait for the parliament, through notification they can tell whatever amendment we have brought in through Finance Act 2025 stands omitted. Like that they can bring. That is known as power not to levy tax or power to reduce the tax whenever it is as a past general practice. Say this. Power not to recover goods and services tax not levied or short levied as a result of general practice, notwithstanding anything contained in this act, means this section will override. If government is satisfied that a practice was or is generally prevalent regarding levy of central tax, okay, for example gold jewelry 3%, on any supply of goods or service or both, and such supplies were or are liable to central tax in case where according to the said practice central tax was not or is not being levied, or a higher amount of central tax, in this case a higher amount of central tax is being levied, a higher amount of central tax is being levied in accordance with the said practice, the government may, on recommendations of the council by notification official gazette, by notification in official gazette, okay, by notification in the official gazette, direct that the whole of the central tax payable on such supplies but for the said practice shall not be required to be paid, shall not be required to be paid in respect of the supplies on which central tax was not paid or is not being levied or was or is being short levied in accordance with the said practice. As per the past practice, on jewelry 3% only, now they increased on making charges 18%. So whether the government has power not to levy the taxes? Yes, by notification official gazette shall make a notification for what? So shall not be required to be paid, tax shall not be required to be paid in respect of the supplies on which the central tax was short levied, so no need to pay that. That's what rollback provision. You can remember it like rollback provision. Rollback provision. Okay. And same way, in the past, there was no tax on a particular transaction. Suddenly, they have brought it into the taxability. Whether government is having power to roll it back? Yes, yes. Previously, no tax was levied, not levied. Now they are starting levying. Can they roll back? Yes, they can roll back. For example, few years ago, restaurant services were charging a service charge as a part of their bill, but they were not applying GST to it because of a common industry practice. The CBIC later clarified that GST should be levied on the entire bill, including the service charges. Using this provision, the government could issue a notification that as a general practice, as restaurants are not charging GST on service charges, so the GST on such service charges may be exempted like that. That's what rollback provision. That power is there. Previously, that power was not there, which means they need to wait again for the GST council meeting and parliament approval. But now, in this case, the government can suo motu on its own based on the people's request in general practice. So, public at large should be affected. Then in that case, they will be coming out with this notification. Next. Then we have 9th point, services provided by training partner approved by NSDC or NCVET is exempted. So, this point here, what happened is that previously this NSDC, National Skill Development Corporation, they used to have three bodies: awarding body, assessment body and training body, like the three bodies. What awarding body will do? Will give the certification, and what assessing body will do? Will conduct the test examination. So, conducting the question, creating the question paper, conducting the test. And what this training body will do? Training body will create the curriculum. What is the course? What should be taught, etc. and all that training body will create. Okay, wow. So, three bodies under National Skill Development Corporation and NCVET, National Council for Vocational Education and Training. Okay. So, these are the two premier institutions for skill development in India. Below this, there used to be three bodies. First, a training body. What it will do? It will not conduct the training. It will create the curriculum. What course curriculum it will design. And next, assessment body. Based on this curriculum, assessment body will create a question paper and do the testing. And finally, awarding body will give the certification to the candidates. Now, training partners. So, who are training partners? That curriculum need to be taught to the students, teachers. So, our institutions, coaching centers, the training partners previously, whether exempted or not, was a confusion. And finally, there was a big debate. So, no, training body is only exempted, training partners are not exempted, which means these coaching centers are required to pay GST, etc. and all. Finally, they have brought in this circular wherein they are telling, this point they are telling that even training partner is also covered under the exemption they added. So, National Skill Development Corporation set up by Government of India, National Council for Vocational Education and Training, awarding body recognized by NCVET, assessment agency. That's what awarding body, assessment agency, training body. Now they added training partner approved by NSDC in relation to National Skill Development Program or any other scheme implemented by the National Skill Development Corporation. So, training partner also they have added, but that training partner should be approved training partner. Just like that, one coaching center is doing skill courses does not mean that it is exempted. So, they should be approved by NSDC. Now, look into this question related to this. Skill Bridge Private Limited, a GST registered training organization based in Hyderabad, enters into the following arrangements in January 2025. It signs a MOU with National Skill Development Corporation to act as an approved training partner. It's an approved training partner under Pradhana Mantri Kushal Vikas Yojana, a scheme implemented by NSDC. It conducts training on retail sales associate skills aligned to NSQF level 4, that is called as a curriculum. Okay, like they will be giving level 1, level 2 like that, and receives 50 lakhs from NSDC for this purpose. However, they are not a training body accredited by NSDC. Okay, even if they are not a training body, but the money received by them is exempted because they are approved training partner. So, the first point will be exempted. Second, It provides soft skills and spoken English training independently to college students, charging 6,000 per student without any NSDC affiliation or recognition from NCVET. The program is not aligned with NSQF. NSQF is National Skill Qualification. Okay. So, not aligned to that, which means it is not covered under the list. So, therefore, it is taxable. So, this 6,000 rupees per student will be taxable. They are neither approved awarding body or assessment agency or a training body or a training partner. Then number 3, it provides service as an awarding body. Awarding body, no doubt, it will be exempted. Awarding body recognized by NCVT by way of designing the curriculum for training in mobile handset repair. The training program is part of a qualification package approved by NCVT and aligned to NSQF level 3. The program is funded by State Government Skill Mission. It is covered under exempted because they are covered under awarding body, approved awarding body. See, that's what 4 people you remember: assessment agency or assessment body, awarding body, training body or a training partner. Okay. Then next one, exemption with respect to services provided by Motor Vehicle Accident Fund. What is this Motor Vehicle Accident Fund? Listen carefully. Now, you purchased a 2-wheeler or 4-wheeler, and whenever you purchase a 2-wheeler, 4-wheeler, you need to take the insurance. In that insurance, there is a point called as third party insurance. What is third party insurance? You drove your vehicle and any accident happened. If there is any loss to your vehicle, normal insurance will cover. Insurance will cover. This comprehensive insurance or bumper to bumper insurance, etc., that will cover. So, the garage will provide the repair and the insurance company will make the payment to garage. That's okay. But you hit the other person. Na? What about the loss suffered by the other person? Then in that case, there is some amount which you pay as a part of your insurance premium called as third party insurance premium. In the total insurance premium, one part will be for third party, that is for the other person. This third party insurance, whatever premium is collected from the motor vehicle owners, will be contributed to the Motor Vehicle Insurance Fund, which is maintained by government under Motor Vehicles Act. Now, the other person who suffered the loss because of you will be paid money out of that Motor Vehicle Insurance Fund by the government. Example, one lorry hit the car. Now, in this case, on that lorry, the third party insurance will be taken, or normally one person is going on road, you hit the person is injured or dead, etc. From where the compensation will be paid? Out of the Motor Vehicle Insurance Fund. How money will come into Motor Vehicle Insurance Fund? We pay the third party insurance to the insurance companies now. Out of that it will be contributed. That's why traffic police, every time when he catches you, he will check whether third party insurance is there or not. Your vehicle, whether you take insurance or not, it's okay. But the third party insurance you should have taken, it is mandatory. That is why traffic police will definitely check for the third party insurance, and that's why many people will be telling, at least if you are not renewing insurance, it's okay, but the third party insurance alone you renew and keep like that, they will tell. This is the main reason why they will do that. Now, this Motor Vehicle Insurance Fund is like a group insurance fund from whom they will be collecting, all the insurance companies they will be collecting. Generally, some group insurance funds are exempted. What are they? Army, Navy, Air Force, Coastal Guard, Central Armed Police Forces. Along with that, Motor Vehicle Insurance Fund is also exempted. Okay, say this. Service of insurance provided by Motor Vehicle Accident Fund, constituted under section Motor Vehicle Accident Fund. It's like a group insurance, okay, under section 164B of Motor Vehicle Act, against contribution made by the insurers, okay, out of the premiums collected for third party insurance of motor vehicles. Out of the premium, third party insurance premium, the insurers, insurance companies will pay this. So, see the explanation relating to this. The Motor Vehicle Accident Fund is constituted under section 164B of Motor Vehicle Act 1988. It is a statutory fund. The fund is used to provide compensation or medical treatment to victims of motor vehicle accidents, hit and run cases, unidentified vehicles, etc. How it will be funded? Funded through contributions made by the insurance companies. These contributions, how the insurance companies are making out of the premium collected on third party motor vehicle insurance. Whether the third party motor vehicle insurance premium collected by insurance companies is exempted, no, that is taxable. That is, insurance company will collect the third party insurance premium, that is taxable. But thereafter they contribute it to the motor vehicle accident fund, that contribution they made and collected by government is exempted. Therefore, the contributions collected under this fund is exempted. Now see this question. Sure Life Insurance Limited, a registered general insurance company, collects premium from policyholder for third party motor vehicle insurance. As per the Motor Vehicle Act 1988, the company is mandated to contribute a portion of such premium collected to the Motor Vehicle Accident Fund constituted under section 164B of the Act. The fund is used to provide insurance or compensation to victims of hit and run motor accidents and to meet certain emergency medical expenses. During financial year 25-26, Sure Life collected 100 crores in third party insurance premium, contributed 4 crores to the motor vehicle accident fund as per the statutory obligation. Okay, how much they collected? 100 crores in third party and 4 crores to motor vehicle accident fund as per statutory obligation. Sure Life is uncertain whether GST needs to be paid on the service of insurance provided by the fund against such contributions. Whether third party insurance premium collected is chargeable to GST. Yes, the third party insurance premium collected is taxable. This 100 crores will be taxable. But analyze whether the service of insurance provided by motor vehicle accident fund are subject to GST, that is exempted. If the fund later makes payment to victims or their families, would such payout be treated as taxable consideration? No, because it is compensatory in nature. Do you remember the circular on liquidated damages? If any money is received for the compensatory nature or penalizing a person to discourage an act, that will not be treated as consideration. So this compensation, whatever is received by the injured, will be coming under compensatory in nature. Liquidated damages which are compensatory in nature are not treated as consideration. Okay. So A, yes, third party motor vehicle insurance premium collected by insurers is taxable under GST, no doubt. Then contributions made by insurers like Sure Life to fund are not subject to GST as they are statutorily required to be paid, which is covered under the exemption. The payouts made by the fund to accident victims or their legal heirs are not treated as consideration. Why it is not treated as consideration? Because it will come under liquidated damages which are compensatory in nature and hence do not attract GST. So this is what you need to keep in mind. Okay. Then next, so like that they can connect that circular on liquidated damages to this point. Okay, see nowadays questions and all are like this, wherein from one aspect only you cannot see, even the other points also can be connected here. Now we are moving on to the next one, applicability of GST on facility management services provided to Municipal Corporation of Delhi. Municipal Corporation of Delhi, is it government? Yes, Municipal Corporation of Delhi is government. And we have one point, any service provided to government in relation to an activity under 243G or 243W of the Constitution is exempted. Okay, so there is a government which is required to do certain activities as per 243G or 243W of the Constitution. Who government is required to do as per 243G or 243W of the Constitution to the general public or to business entities. They outsource it to you. They outsource it to you. And you are providing that services to government. If it is a pure service, it is exempted. This is one exemption. One more point is there. If it is a composite supply of goods or services, both goods and service will be there. First example, you can take this solid waste management. Solid waste management means cleaning the garbage, etc. That's a pure service, which the government has to do as per 243 GRW, but which they outsourced to you. And you are providing that services to them. That is fully exempted. That is one point. Another point is there. What is that another point? Composite supply of goods or services where the value of goods does not exceed 25% of the total, that is also exempted. Example, laying down cement road, whose work? Government work, but they outsource it to contractor. The contractor is laying down the cement road. The value of the goods does not exceed 25% or exceeds 25% of the total, exceeds 25% of the total, so it is taxable. What if the value of goods does not exceed 25%? For example, sanitation, like filling the drainage with pesticides, etc. and all. In that case, definitely the value of goods does not exceed 25% of the total. Am I right? Then it is exempted. This is the exemption which we already have. But now the point is, this municipal corporation of Delhi government is receiving facility management services. Facility management services means what? Some housekeeping services, some cleaning services, etc. for their office building. Okay. Will it come under pure service or composite supply where the value of goods does not exceed 25% and it is exempted? No. Why? Carefully listen. First of all, this activity should be the activity or obligation of the government as per constitution. First, this activity what they are receiving, whatever service they receive, that should be their obligation to provide to the general public. That should be their obligation to provide to the general public as per constitution. For which if they outsource, then it will be coming under the exemption. But first of all, this facility management services which they are receiving is not their obligation to do it to the general public. So in that case, whenever they receive the services, we cannot take ITC. A similar point like this even we have in previously related to army. Indian army receives sanitation services, whether it is exempted. Same point we have read, wherein it is not the work of the Indian army to provide the sanitation to general public. So if they receive the sanitation services, they will not be able to claim the exemption with respect to that. Okay, same way, say this. Entry number 3A provides exemption to composite supply of goods and services in which the value of supply of goods constitute not more than 25% of the value of said composite supply provided to government or local authority. So pure service is exempted or composite supply of goods and service exempted where the value of goods does not exceed 25% of the total. Okay, supply provided to government in relation to an activity entrusted to them under article 243G or 243W of the constitution. The service of facility management such as housekeeping, civil maintenance, furniture maintenance and horticulture agency for the upkeep of office of this municipal corporation of Delhi are not supplied in relation to performing any functions entrusted to municipality. First of all, is it their work to do for general public? No. Such services are not covered under the scope of entry 3A. Thus, it has been clarified that GST is applicable on services provided by Facility Management Agency to MCD Delhi for upkeep of its headquarters. So, first it should be the activity of that government to do it to general public, and when they outsource it, then only that outsourced activity is exempted. Okay. Now, say this, question number 3. Examine whether GST is exempted in the following independent cases of supply of services. Apex Facilities provided civil maintenance service for the upkeep of Municipal Corporation of Delhi head office building. Value of supply of goods constitute 20%. Even though the value of supply of goods does not exceed 25% of the total, first of all, it is not the work of the Municipal Corporation of Delhi to provide it to the general public. Due to that reason, exemption is not applicable and it will be taxable, not exempt and it will be taxable. So it's an RTP question. Messrs. Talreja and Talreja, a firm of advocate, provide legal services to state government for representation in High Court. Exempted. Services provided by individual advocate or firm of advocate or arbitrator to central government, state government, local authority, government authority or government entity is exempted. Next. So therefore, second point, it is covered under the exemption. Next, BLF Mall, Noida provides services by way of vehicle parking to general public in the basement of the mall. So whatever parking, renting of which property? Commercial property, definitely it will be taxable, no exemption and all here. So it is not specifically exempted, therefore chargeable to GST. Services provided by a private transport operator to Scholar Boys Higher Secondary School by way of transportation of students to and from the school. So transportation two educational institution. This is two educational institution. Which educational institution? Category 1 educational institution. Therefore, transportation of students, faculty and staff to this institution will be exempted. So, services provided by them will be covered under the exemption. Now, we are moving on to the next exemption, that is exemption with respect to card transactions, card. So, credit card, debit card, charge card or any other payment card service up to 2000 rupees in a transaction. So, this exemption was already there. So, in banking services we had this exemption. If there is any processing fee for card transactions, that is card, any card, debit card, credit card, charge card or any other card transaction, there will be some processing fees. The acquiring bank will be collecting some processing fees, and that processing fees will be exempted from GST if the transaction, card transaction is up to 2000 rupees. Okay. So, that is you are making a swipe amount and the swipe amount does not exceed 2000 rupees. There will be some processing fees which is collected by the acquiring bank, who will make a debit from your account and credit to the vendor account. So, on that processing fees, the GST will be exempted. Now, what is the issue here? The issue is with respect to online transactions. You can use your card and make the payments through online also. So, there are a lot of payment gateways, so like Razor Pay, Phone Pay, PayU, etc. So, even Citrus Pay, etc. A lot of people are there in this, and whenever they do the payment, like you make the payment through card rather than going to the shop using your debit card in the POS device, that is point of sale device. Rather than doing that, what you do is that you make the online payments using the card. Then how it works? Even then the processing fees will be there. Yes, even then the processing fee will be there. So, these payment aggregators called as Paytm, Razor Pay, etc., what they do is that they collect the money from you, and that is from your bank, and they will keep it in escrow account, and thereafter they will settle it to the vendor. For doing this, they get a processing fees. That processing fees is also exempted. Will they come under acquiring bank? Yes, they will also come under acquiring bank, even though they are not called as bank, but they will come under the meaning of acquiring bank. How? Let's try to understand. So, entry number 34, what does entry number 34 deals with? Entry number 34 exempts service by an acquiring bank related to settlement of a card transactions up to 2000 rupees in a single transaction. What is the meaning of acquiring bank? Acquiring bank means banking companies, financial institutions or any person making payment to card accepting merchants. So, this any person making payment to card accepting merchants, under that any person we have payment aggregators. So, payment aggregators regulated by RBI, yes, they are regulated by RBI, collects payment from customers and transfers funds to the merchants. Hence, they handle money and they will come under acquiring bank. Therefore, RBI regulated payment aggregators are eligible for this exemption. Of course, transaction should be up to 2000 rupees. And what about payment gateway charges? This is the payment settlement services, payment settlement charges. But payment gateway charge is there. What is payment gateway charge? They are facilitating you one browser, web page, you can enter your details, make the payment, etc. and all. Now, that is called as gateway charges. For payment gateway charges, we don't have any exemption. That will be taxable. Payment gateways who merely provide technology infrastructure without handling funds are not eligible for this exemption, that will be taxable. So, we will divide it into two. Amount collected by payment aggregator for online transactions, that is RBI approved payment aggregators. If it is settlement charges, that is processing charges, if the transaction is up to 2000 rupees, one transaction is up to 2000 rupees, then the processing charges will be exempted, everyone. Whereas if it is exceeding 2000 rupees per transaction, entirely it will be taxable. What about gateway charges? Gateway charges will always be taxable, whatever may be the case. Now, let's see the next amendment that we have in time of supply. In time of supply, so we have vouchers related one clarification, but already we know this clarification. Is voucher goods or services? We already know that voucher is neither goods nor services. Why is it so? Generally what happens in case of voucher is that, so whenever you are getting the voucher, which means that you can redeem that voucher towards purchase of any product or service, correct? You can redeem that voucher against purchase of any product or service, which means a voucher will be treated as consideration. So there are vouchers which are divided into two: approved by RBI, not approved by RBI. Prepaid instruments, PPIs. Prepaid instruments, PPI, like that it is there. For example, Amazon gift voucher, Flipkart gift voucher and all you can buy. Even some shops are there, lifestyle, then shopper stop or jewelry shops. In that places and all, you can buy the voucher, you can buy the gift voucher. That will be called as prepaid instrument, which is recognized by RBI, which is approved by RBI, which means they will be coming under money category. If it is money, then it is neither goods nor services. Okay, so look into that particular point here, where you can see. So GST treatment of vouchers. What is the GST treatment of voucher? First, there is a definition for voucher. A voucher is an instrument that can be used as a consideration or part consideration for a future supply of goods or services. So it can be treated as consideration or part consideration against supply of goods or services. Basically, in these vouchers there are some prepaid instruments like wallets, cards, etc., which are regulated by RBI, or subset of vouchers. Example, Flipkart gift voucher, Flipkart gift voucher, Flipkart gift voucher, and then so this Joy Lucas or any jewelry shop. Okay, so Joy Lucas gift voucher. These are all examples of prepaid instruments. And whether voucher is supply. If the voucher is a prepaid instrument recognized by RBI, it comes under money definition. Money is, because any instrument recognized by RBI will come under money. Money is neither goods nor services. Since money is excluded from the goods or services, so voucher is neither supply of goods nor supply of services. Consequently, there is no GST. Sir, what about normal vouchers, promotional vouchers which are given by the shops? Like if you buy for 2000 rupees, you will get a 500 rupees worth voucher from Reliance Trends. That is prepaid voucher or not a prepaid voucher? Not a prepaid voucher, because you are not making any payment for it. It is a pure gift voucher. In order to promote the sales, you are getting that. So if the voucher is not recognized as a prepaid voucher, just remember Reliance Trends or Zudio or this West Side, etc., these vouchers not treated as money, such voucher is an actionable claim. Okay, why? Because number one, you have a Reliance Trends voucher of 500 rupees. Do you have right to receive the benefit? Yes. Is it legally enforceable? Yes. Tomorrow if they say no, we will not give any discount like that, no, they have to, legally enforceable. Number 3, can be transferred. Yes, the voucher can be transferred to any person. Number 4, the holder of that voucher is entitled to receive the benefit. Correct. All the 4 conditions for actionable claim is satisfied. Therefore, other than prepaid vouchers will come under actionable claim. Not treated as money, but that voucher is treated as actionable claim. But is it covered under specified actionable claim? No, it is not covered under specified actionable claim. But it is other than specified actionable claim. What are the specified actionable claim? HC block is only specified actionable claim. So it is other than specified actionable claim, which is not covered under supply, excluded from supply. Why? Because in exclusion from supply, 7 subsection 2 read with schedule 3. So we have actionable claims other than specified actionable claims is excluded from supply. Accordingly, it is also neither supply of goods nor supply of service, and there is no GST. What is the conclusion we can draw? Whenever we are giving voucher, it may be a prepaid instrument or not, that voucher is not a supply and will not be chargeable to any GST. Voucher per se voucher is not a supply, but that voucher will be redeemed against supply of goods or services, that will become supply. Okay, this voucher, when you redeem some product or service is being supplied now, that is called as supply. Next, when transaction in vouchers is chargeable to GST, if it is a principal to principal basis. What does that principal to principal basis means? That is, there is a shopkeeper, for example, Shopper's Stop. Shopper's Stop wanted to promote its business. For that reason, they will be appointing some marketing agencies. What these marketing agencies will do, they will be, marketing these vouchers to the corporates. Now, corporates wanted to give gifts to their employees. Rather than giving money or anything as gift, so they will be giving Shopper's Stop voucher as a gift to their employees, who corporates. Now, three parties are involved: shopkeeper, that is Shopper's Stop, okay, and then marketing agency, and the company which buys the voucher through this marketing agency and give it to their employees. Got it? Now, if this particular marketing agency buy the voucher from Shopper's Stop and sell the voucher to companies, say for example 500 rupee voucher they will buy at 400 and sell at 500 rupees to the corporate, then it is on a principal to principal basis, wherein purely it is purchase and sale, so there is no GST at all. Okay, again I am repeating. So what Shopper's Stop is doing, first Shopper's Stop is a store and there is a marketing agency, okay. So marketing person, this marketing person is distributing it to companies, is distributing it to corporates. Now Shopper's Stop will make sale at sale of voucher paide. This is sale of voucher, sale of voucher at rupees 400. And what marketing person will do, will make sale of voucher, at 500 rupees. Now in this case, the Shopper's Stop and the marketing person is acting on principal to principal basis, P2P, principal to principal basis. So this 400 rupees is not a supply. Even the marketing person selling this voucher for 500 rupees is also not a supply. Okay, so it is not a supply. Where is it given? See that. Distributor buys vouchers at discount and sells at a markup. Owns vouchers, operates independently. No GST on voucher sale. It's just a trading in money and action or actionable claim. So there is no GST on that. Suppose if there is a slight change, okay, instead of doing it like this, there can be a principal to agency model. Okay, what is that principal to agency model? So say this marketing person will not buy the voucher, directly Shopper's Stop only will make the sale of voucher to the companies. Okay, Shopper's Stop will make sale of voucher to companies, and as this is facilitated by this marketing person, Shopper's Stop gives a commission. To this marketing person. Now in this case what will happen? Now the Shopper's Stop and marketing person is working on P to A basis, principal to agent basis. This commission will be chargeable to GST. This is supply under 71A, and GST payable on this commission. But this sale of voucher is not a supply. This sale of voucher will not be coming under supply. So say this, distributor acts as a agent of voucher, gets commission or fee for marketing or distribution. GST is payable on such commission or service fee. That is about this. So apart from this, any other services like marketing, advertisement, tech support, co-branding, customization, all these are independent services not connected to the voucher. I mean like not sale of voucher, that will be subject to GST. Then one important point, what if the voucher expires? If the voucher expires, why the voucher will expire? Because every voucher will have a validity. If the voucher expires, what will happen? So there won't be any GST liability. Only when the voucher is redeemed against supply of goods or services, there will be GST liability. If the voucher expires, there won't be any GST liability. But before that, I wanted to connect with time of supply provisions. In time of supply provision, section 12 subsection 4 and 13 subsection 4 of CGST Act. What does it says? The time of supply in case of vouchers, identifiable voucher is at the time of issuance of voucher. Non-identifiable voucher is at the time of redemption of voucher. What is identifiable voucher? If there is a product or service which is mentioned on the voucher, it is identifiable voucher and it can be redeemed against a particular product or particular service. But non-identifiable voucher can be redeemed against any product or any service. That is non-identifiable voucher. For example, so voucher that can be redeemed against purchase of only a handbag, identifiable voucher. Rupees 500 Domino's voucher, you can redeem it for purchase of anything in Domino's, that is non-identifiable voucher. Now, identifiable voucher, what is the time of supply? At the time of issuance of voucher. But there is no supply na sir, let it be. Voucher is not a supply. But at the time of issuance of voucher, identifiable voucher, we need to consider that the product has been sold. For example, we are giving a voucher for a handbag. Now, whether the person is redeeming it or not, today itself we need to consider that the handbag has been sold and we need to pay GST. What if that person is not coming and redeeming the voucher? Then, in that case, unnecessarily we paid the GST, we need to get the refund of the GST paid. Second, what if it is non-identifiable voucher? Non-identifiable voucher, always the time of supply is at the time of redemption. What if he is not coming and redeeming? There is no liability at all. Okay, that is the meaning here. If the voucher expires unused, the retained amount by the issuer, so maybe some amount they would have collected na, prepaid instrument means some amount they would have collected, is called breakage. Since no underlying supply of goods or service occurs, no GST is applicable on breakage, which means any GST liability is there or GST liability is not there. GST liability is not there, GST is not at all payable. Is it clear? GST not payable. What if they have already paid GST? They will get the refund of the GST paid. Now look into this question. Gift Cart India Private Limited is an Indian startup that issues prepaid gift cards and vouchers redeemable at multiple retail outlets and e-commerce platforms. These vouchers are issued both as RBI recognized prepaid instruments, reloadable digital wallets and closed loop gift cards not recognized by RBI. Gift card enters into two types of arrangements for distribution. With Happy Distributors Private Limited on principal to principal basis, where HDPL purchases 10 lakh worth of vouchers at a 10% discount and sell them to corporate at face value. There is no GST on that. With ClickPay Solutions LLP as an agent, where ClickPay distributes vouchers via online platforms and earns a commission of 1.5 lakh per month. ClickPay also charges 50,000 rupees per month for tech support and marketing services related to voucher issuance. Okay. Now, during financial year 24-25, Gift Cart reports 3 lakh worth of vouchers that expired and unredeemed. It has issued both RBI regulated PPIs and closed loop gift cards under these models. Examine whether GST is applicable and compute GST liability, if any, on the above transactions if such vouchers are recognized as RBI regulated prepaid instruments or not recognized as RBI. Suppose, first case, sale of vouchers to HDPL, how much? 10 lakhs at a discount of 10%. So there is no GST because these vouchers, if recognized by RBI, is money. If not recognized by RBI, then it is actionable claim. So there is no GST on this. So no GST is applicable because either it will come under money or it will come under actionable claim, and there won't be any supply, consequently GST not payable. Second, what about this commission? Commission 1.5 lakh per month. ClickPay as an agent, where ClickPay distributes vouchers via online platforms. What about this 1,50,000? ClickPay acts as agent, earning a commission of 1.5 lakhs and service fee of 50,000, and both will be taxable. Therefore, GST liability will be 1.5 lakh plus 50,000, 36,000 will be the GST liability on click pay. What about the unredeemed vouchers of 3 lakhs? So 3 lakh worth of vouchers expired is not liable to any GST since there is no underlying supply, and consequently even though we have received some money, but that will not be chargeable to any GST. No GST on breakage. There is no express or implied agreement to forfeit or charge for non-redemption. So due to that reason, GST liability shall not arise. So as this September exam, there is an important clarification related to vouchers. There is a high chance that this point can be tested. Maybe they can coin a question like this. Okay, they can coin a question like this for your exam. This is related to the vouchers that you need to remember. Now we are moving on to the next amendment, that is time of supply in case of services covered under RCM. So what will be taken as time of supply in case of service under RCM? There are few points here, notable points you need to understand. Generally in case of RCM, who will be giving invoice to whom? Supplier will be giving invoice to recipient, or recipient will be giving invoice to supplier. Generally, if the supplier is registered, supplier only will give invoice. See, I am discussing this in the context of RCM, keep in mind, okay. So this is in the context of RCM. In the context of RCM, I am making the discussion, okay. In the context of RCM, if supplier is registered, of course recipient is also registered. So who will be giving invoice to whom? Definitely supplier only will be giving invoice to the recipient. Invoice is given by supplier to recipient, no doubt. Then suppose if the supplier is unregistered, and the recipient is registered, then who will be giving invoice to whom? Sir, recipient will be giving invoice to supplier. This is called as self invoice, but this is only in the context of RCM. So when supplier is registered, recipient is registered, if the supply is covered under RCM, supplier only will give invoice to the recipient. But when supplier is unregistered, the recipient is registered, the recipient will be giving self invoice to the supplier. Okay, what is the time limit for this self invoice? 30 days from the date of receipt of goods or services. Within 30 days from the date of receipt of goods or services. So whenever the recipient has received the goods or services, from the date within 30 days, the invoice, self invoice needs to be issued. Okay. Now, what is this we are discussing now? What is the time of supply as per services under RCM? So this is the provision, what we have updated provision. In case of supplies in respect of which tax is paid or liable to be paid on reverse charge basis, the time of supply shall be earlier of the following dates. This is service under RCM, section 13 subsection 3 pa. Section 13 of CGST Act deals with time of supply in case of service. In that subsection 3 is RCM. What they are telling, the date on which payment is entered in the books of accounts or the date on which payment is debited in bank account, whichever is earlier. Usually when the service is covered under RCM, from whose point of view you will determine the time of supply? From recipient point of view. So recipient point of view, we need to check the date on which recipient is making payment to supplier, that is this A. B, the date immediately following 60 days from the date of issuance of invoice or any other document by whatever name called in lieu thereof by the supplier, in case where the invoice is required to be issued by supplier. Okay. Or the date of issue of invoice by the recipient in case where the invoice is required to be issued by recipient. So now we have two time of supply provisions. So that we are trying to understand what are those two time of supply provisions. Time of supply in case of what? Services under RCM, where invoice by supplier to recipient. Got it? Time of supply in case of services under RCM where invoice is given by supplier to recipient. This is one version. This is one. So in exam, please check this. Please check who is giving invoice to whom. Time of supply in case of services under RCM where invoice by recipient to supplier, are getting the self invoice pass self invoice, time of supply in case of services under RCM where invoice is given by recipient to supplier. What will be taken as the time of supply in this case? Suppose if supplier is giving invoice, A is common in both the places, A is common, date of payment to supplier, date of payment to supplier, here also same here, date of payment to supplier, same both the places. Then what? Then in this case 61st day from the date of invoice. See, the day following 60 days, the day following 60 days is what? 61st day from date of invoice by supplier. Whereas here it is not 61st day, date of invoice by recipient, simple. Date of invoice by recipient, due data, actual date by which recipient is giving invoice to the supplier, date of invoice by recipient, whichever is earlier, that is same will be taken. Okay, so what we need to see is that first we need to check the date on which payment is made to supplier, 61st day from the date of invoice by supplier, whichever is earlier. This was a provision which was there even before also. Before also this provision was there, but now they added this because of the self invoice. Date of payment to supplier or date of invoice by recipient. See there. Date of payment common pa. This point, B point will not come. C point, the date of issuance of invoice by recipient in case where the invoice is to be issued by recipient. Okay. Then the proposed amendment to 1331(3)(f) deal with the provisions for determining the time of supply for issuance of self invoice in case RCM is applicable. These are the changes. First, what should be taken as the time of supply under RCM? So the time of supply will be the date on which payment is made or the date of issuance of invoice by recipient, whichever is earlier, because this A point is also there, C point is also there, whichever is earlier of the following dates, that's why. And what is the time limit for self invoice? When self invoice is applicable, whenever the supplier is unregistered, the recipient is registered, then the recipient has to give the self invoice to the supplier in case of RCM, that is this. And time limit for issuance of self invoice, 30 days from the date of receipt of goods or services. And there is one explanation that has been added. Generally, in case of TDS deductors, who are TDS deductors? Government departments, etc. or TDS deductor na, central government, state government department, local authority, public sector undertaking, etc. is there na. So TDS deductors, if they are registered for deducting TDS, and if at all you are making purchase from them where you are required to pay GST under RCM, of course services provided by government to business entity is covered under RCM, and the government department is registered only for the purpose of deducting TDS, they don't have a normal registration. Now, how we need to treat the supplier as unregistered person, and the recipient should give invoice to the supplier. A very important point, crucial point, say this. Pa, there is a government department pa, government department. So this government department is making some supply of services to whom? To a business entity, and that business entity is registered. Okay, will it come under RCM? Of course yes, it will be taxable under RCM. Now whether the government department is registered or not registered, the government department is registered only as TDS deductor under GST. Under GST they are registered only as TDS deductor. Now who will be giving invoice to whom? For the purpose of invoice, treat this government department as unregistered person because they are registered only for deducting TDS, which means they should be treated as unregistered person. So the business entity which is registered should give self invoice. Self invoice, that is the explanation they have added. So read this. The amendment also introduces an explanation stating that a supplier who is registered only for deducting TDS will be considered as an unregistered person for the purpose of reverse charge. This means that if the recipient receives supplies from such a TDS deductor supplier, they will be required to issue a self invoice as though the supplier were unregistered. Okay, as if the supplier is unregistered, they need to give the self invoice. So this point don't forget. Okay, even though government department or even though they are registered, but they are registered only as a TDS deductor. So which means every TDS deductor will have two types of registrations. Yes, TDS and TCS deductors will have two types of registration. One as a normal registration, another one will be as a TDS or TCS deductor registration. So who is a TCS deductor? E-commerce operator. So means e-commerce operators will have two registration. One normal GSTIN. So they will file GSTR1, GSTR3B, etc. Another will be TCS registration, wherein they will be filing only GSTR8. Same is the case for TDS deductor. They will have one normal registration for payment of regular liability. For example, you take Indian Railways. Indian Railways will have one normal registration for payment of their regular liability, plus one TDS deductor registration also only for the purpose of deducting TDS and filing GSTR7. Is that clear? So therefore, if they have only one registration as TDS deductor, normal registration is not there, they should be treated as unregistered person only. Got it? Now sir, when can we take ITZ in case of services under RCM? When can we take ITZ? Keep that in mind. So these are all connecting provisions. When they can take ITZ in case of service under RCM? In case of service under RCM, they can avail ITZ whenever the invoice is raised by recipient to supplier. Okay, when the ITZ can be availed, this was a May 25 point itself. This was a May 25 amendment itself, when the recipient can avail ITZ in case of RCM. Whenever self invoice is given, whenever the recipient issues the invoice to the supplier, say there is a self invoice case, when the ITZ can be availed. So there is a supplier who is unregistered, and there is a recipient who is registered. There is a supplier who is unregistered, recipient who is registered, and the supply is made. Supply is made on say 5th of July 2024, supply of services on 5/7/2024, which is taxable under RCM. Are you understanding this? Now in this case, who should be giving invoice to whom? Recipient should give invoice to the supplier. What is the time limit by which recipient should give invoice to the supplier? 30 days, correct? Self invoice to be given here, self invoice to be given. What is the time limit within which the self invoice to be given? 30 days. The self invoice to be given, say self invoice is issued on somewhere like 3rd August 2024. Self invoice is on 3rd August 2024. Within 30 days only they have given. Now for which month the recipient can avail ITZ? The recipient has to avail ITZ. Which month recipient can avail ITZ? So recipient, because whatever GST paid under RCM, we can avail ITZ. Recipient can avail ITZ. In which month? July 2024, August 2024, August 2024. Whenever the invoice is issued by recipient to supplier, then only they can take ITZ. Recipient can avail ITZ for August 2024. For August 2024, they file 3B na. For August 2024, they file 3B. So in that 3B, they will be able to take ITZ. When they will file 3B for August 2024? 20th of September. By 20th of September, they will be filing 3B. In that, they will be able to take ITZ, but not for July month. Sir, This was the amendment for May exam itself. Okay, and so what we usually do is that whenever the payment is made under RCM, in that month only we used to take the ITC. Whenever recipient is making payment to supplier, that is whenever recipient is paying tax, in that month itself they used to take the ITC. But now they are telling that based on the invoice they can take ITC. So recipient can avail ITC for August 2024. Clear? Now here, and what is the usual time limit for availment of ITC? This is the minimum time limit pa. This is the minimum time limit. This is the minimum time limit. I am talking about the maximum time limit by which they can take ITC. What is the maximum time limit? Maximum time limit, we need to check the regular provisions of section 16 subsection 4. What is section 16 subsection 4 says? 30th November of succeeding financial year. For self invoice given in August 2024. August 2024 means it is which financial year? So it is financial year 2024-25. Financial year 2024-25. So 30th November of 2025, or B, date of filing annual return. Date of annual return, whichever is earlier will be taken as the maximum time limit by which this ITC can be availed. Minimum time limit August month. August month whenever they are filing the 3B pa. But suppose if they miss, what is the maximum time limit? Based on invoice only you check. What is the invoice? 3/8/2024 na. So therefore 30th November of 2025 or date of filing and return, whichever is earlier should be taken. This is the time limit for ITC. Now covering all these things, that is covering the self invoice point, covering the RCM point, covering the time of supply point, we have one very good comprehensive question that we are going to discuss now. Okay, so see this question. XYZ Private Limited, a registered company under GST whose aggregate turnover during the previous year exceeds threshold limit, procures legal consultancy services from Mr. Santanam, an advocate who is not registered under GST. So first this paragraph you see, XYZ Private Limited, a registered company under GST, okay, whose aggregate turnover during the previous year exceeds threshold limit, procures legal consulting services from Mr. Santanam, an advocate services to a business entity whose turnover during the previous year exceed threshold limit, is taxable, and it will come under RCM. Correct? This is a service covered under RCM section 9 subsection 3, read with notification 13 of 2017. Advocate service, arbitrator service to business entities covered under RCM. Don't forget this. Okay. The legal consultancy services are provided on June 15, 2023, and Mr. Santanam charges a fee of rupees 1 lakh, which is paid by XYZ Private Limited on June 16. So what is the date on which supply is made? The date on which supply is made is June 15, is the date on which supply is made by advocate, and when the payment has been made, the payment has been made by Santanam, by XYZ Limited to Santanam in June 16, 2023. Payment is made the next day. However, the self invoice needs to be given in this case. Why self invoice? Supplier is unregistered, the recipient is registered, and the recipient has to give the self invoice to the supplier. Correct? What is the time limit within which the self invoice to be given? Within 30 days from the date of receipt of goods or services. What is the date of receipt of goods or services? June 15, 2023. From there 30 days you take, that is July 15, 2023 is the time limit by which the self invoice needs to be given. Correct? Now, however, the company accountant issues the invoice for legal consultancy services only on August 20, 2024 and pays the applicable GST in GSTR 3B of August 2024 filed on September 18. So what they are doing here? What accountant is doing? Bloody idiot accountant. So accountant is giving invoice on August 20, 2024. When it should be given? 1 month, 30 days, that is July 15, 2023 it should be given, means next year he is giving invoice leisurely, okay, and pays the applicable GST accordingly, and pays the applicable GST in 3B of August 2024 filed on September 18, 2024. and wanted to avail ITC in August 2024. Answer the following questions. First question. Who is liable to pay GST in this case? Already we know. As per section 9 subsection 3, the liability to pay GST is on the recipient, that is XYZ Private Limited. So therefore they need to pay GST in this case. That is the answer for the first part. 9.3 read with notification 13/2017. Advocate services, liability to pay GST is on XYZ Private Limited. Then second, what is the due date of invoice and who is required to issue invoice? Who is required to issue invoice? As the supplier is unregistered and the recipient is registered, as per section 31(3)(f), the recipient has to give self invoice to the supplier. What is the due date of invoice? Within 30 days from the date of receipt of goods or services, that is June 15, 2023 plus 30 days. June 15, 2023 plus 30 days, that is 15 July 2023. Next, number 3. Third question. What is the time of supply of service and due date of payment of GST, assuming the due date of 3B is 20th of next month? So, time of supply we need to take as the date on which payment is made to supplier. What is the date on which payment is made to supplier? June 16. Or the date on which invoice is issued to supplier. Now only we discussed what is the time of supply in case of self invoice. The date of payment to supplier or the date of invoice by recipient, whichever is earlier. What is the date of payment to supplier? June 16. What is the date of invoice to supplier? August 20. Whichever is earlier, definitely June 16, 2023 is only earlier. So see the time of supply. Date of payment to supplier or date of invoice to supplier, 16th June or 20th August, whichever is earlier, that is 16th June. If time of supply is 16th June, then what is the due date of payment of GST? So usually they are telling that GSTR 3B, assuming that GSTR 3B due date is 20th of next month. So therefore 20th of July will be taken as the due date. 20th of July will be taken as the due date. Understood up to this? Time of supply provision. First we saw who is liable to pay GST and who is required to give invoice and what is the time limit for issuing invoice. Then we saw time of supply provision update. This is the latest amendment. Next, when they can avail ITC. By when they can avail ITC? Whenever they gave invoice. When they gave invoice, August 2024, means for August 2024 they can avail ITC. See the next question. By when XYZ Private Limited can avail ITC and whether they can avail ITC in June 2023. So August 2024 only they can take ITC. What is the maximum time limit? August 2024 is the date on which they gave invoice. Which financial year? 24-25 financial year. For 24-25 financial year, what is the time limit? The time limit will be 24-25 financial year. The time limit will be 30th November of succeeding financial year, that is 2025. 24-25 next financial year, PAR 2025. So 30th November 2025 or date of filing and return, whichever is earlier. So see here. Time limit for availment of ITC under 16.4, 30th November of next financial year or date of filing and return, whichever is earlier. Even though services are received in June, ITC cannot be availed in June as the invoice is issued in August. So therefore ITC can be availed in August 2024 or later months, but before this time limit for availment of ITC. Minimum time limit, maximum time limit. Minimum time limit is as and when they gave invoice. Minimum time limit is as and when they gave self invoice. Maximum time limit will be the regular time limit, that is 30th November of succeeding financial year or date of filing and return, whichever is earlier that. Next, another part, last part of the question. Is there any interest payable in the present case? Is there any interest payable in the present case? What is your answer? Whether any interest is payable in the present case? First, as per time of supply, what is the due date? Sir, as per time of supply, the due date will be 20th July 2023. As per time of supply, the due date is 20th July 2023. They should have paid GST. Now, when they are actually paying GST, they gave invoice in August and pays the applicable GST in GSTR 3B of August filed on September 18. Means when are they paying? September 18, 2024 they are paying. What is the due date? 20th July 2023. When are they making the payment? Actual payment of tax. Due date of payment of tax, actual date of payment of tax. Due date of payment of tax is 20th July 2023. What is the actual date of payment of tax? September 18, 2024. So, interest will be calculated from 20th July 2023 till 18 September 2024, number of days. So, July 2023 to July 2024, 366 days. 366 days. Okay. So, then because 2023, 2024, 366 days, 366 days. Thereafter, in July, 11 days, 20th July 2023 to 20th July 2024 will be 366 days because leap year will come. Okay. And thereafter, in July, it will be 11 days. 20th up to 20th you consider. So, 11 days. So, 366 plus July 11 days. Then August 31 days. September will be 18 days. Okay. So, therefore, 366 plus 11 plus 31 plus 18, that will be 426 days. 426 days. For 426 days, we need to compute the interest on what? On the value GST. What is a GST? 1 lakh is the fee. So, 1 lakh into 18% into 18%. 1 lakh into 18% is tax. On that 18% is the rate of interest into 426 by 366, 3,771 rupees. As invoice is issued by recipient beyond due date, even penalty can also be levied in this case. Okay. So, that is the answer for this. Penalty can also be levied on account of delay in issuance of invoice. So, that is with respect to this, and in RTP, they gave one question related to it. Mr. Mutswamy, an electronics dealer registered in Bengaluru, Karnataka, hired Messrs. Parivahan Logistics, an unregistered GTA, to deliver his goods at the place of business of customer in Jaipur, Rajasthan. Messrs. Parivahan Logistics charged 60,000 for the transportation of goods, which was paid by Mutswamy on 4th January through account pay check. The delivery was also made on the same day. Messrs. Parivahan Logistics did not raise the tax invoice for these services since it was unregistered. In the present case, you are required to determine person liable to issue tax invoice. As GTA service is covered under RCM and the supplier is unregistered, so recipient is required to give invoice to the supplier. Okay. So, person required to give invoice is recipient Mutswamy is required to give invoice. And next question, what is the time limit for issuance of invoice? So, first one, who is liable to give invoice? Second one, what is the time limit? 30 days from the date of receipt of goods or services. So, what is the date of receipt of goods or services? So, the transaction, the delivery was made on the same day, that is 4th January. 4th January 30 days means it will be 3rd February. So, 3rd February will be taken as the time limit for issuance of invoice. Then next one, what is the time of supply for transaction providing service by GTA? Assuming that the tax invoice is issued on the last day on which it should have been issued, means the tax invoice is issued on February 3rd. What will be taken as the time of supply? The date on which payment is made to supplier. What is the date on which payment is made to supplier? 4th January, or we have the regular date of invoice, the date on which they are giving the invoice, that is 3rd February, whichever is earlier. So, date of payment 4th January, the date of issuance of invoice by recipient 3rd February. So, the time of supply will be 4th January. Got it? So, like this, they can ask a question. This is easy. Actually, it is easy. RTP question is easy. I made more complicated. I have given even interest provision also related to it. So, this part about vouchers already we completed, and in place of supply, value of supply, we don't have any amendments. Now, we are proceeding to the amendment in input tax credit. There is only one amendment in input tax credit. So, what is it about? Let me give you the background. Generally, there are some conditions for availment of ITC as per section 16. Total 8 conditions we have. Only a registered person can avail ITC. The inward supply should be used or intended to be used in the course or furtherance of business. And The person availing ITZ should be in possession of tax paid document, that is recipient should be in possession of tax paid document, recipient should have actually received the goods or services, and the recipient should file the return in GSTR 3B to avail the ITZ. Then 3 conditions in the hands of supplier. Supplier should report the details in GSTR 1, number 2, and thereafter whatever details that is reported by supplier in GSTR 1 should not be restricted in GSTR 2B of the recipient, and thereafter supplier should have paid the tax to government subject to section 41, means now he don't have to pay, he should have made the payment by 30th September of the succeeding financial year. That's what section 41 says. These are the conditions. In this context, we learned one deemed delivery concept. What is that? When the goods are delivered to some other person on the instructions of the registered person, the day on which the third person has received the goods, it is deemed that the registered person has received the goods and the registered person can take ITC. For example, I am the supplier, you are my registered person, you are the recipient. Basically, I need to deliver the goods to you, but what happened? You asked me to deliver the goods to a third person. Now, I delivered the goods to a third person, but I raised invoice to you, bill to, ship to, transaction, correct? Now, the date on which that shipping address has received the goods, it is deemed that you have received the goods or services. This is normal, correct? So, which means you can take ITC even though you have not actually received the goods or services. The day on which I have provided the goods or services to a third person on your behalf, it is deemed that you have received the goods or service, you can take ITC. Now, in this context, they have given one clarification. Carefully listen. I am a manufacturer and I will be selling goods on X works contract. What is X works contract means? X works contract means at my factory gate, X factory, at my factory gate I will hand over the goods to you. That is called as X factory price or X works contract, wherein at my factory gate I will deliver the goods to you. Now you need to take care of transportation. So you are sending your transporter to my location and I deliver the goods to that particular transporter in my location, my factory gate. This was happened on 28th July. 28th July, carefully listen. On 28th July, I handed over the goods to the transporter, to your transporter. My job is done. The contract got completed. You received it on 3rd August in your place. Now, what will be taken as the date of receipt of goods? Is it 28th July or 3rd August? If it is 28th July, for July month itself, you can take ITC. If it is 3rd August, you will be able to take ITC for August month. You will not be able to take ITC for July month. You will be able to take ITC for August month. What should be taken as date of receipt of goods? For which they gave one point. That is, as and when I handed over, supplier handed over the goods to the transporter, deemed delivery gets attracted. As and when I handed over the goods to the transporter, it is deemed that you have received the goods or services. Consequently, you can take ITC. The deemed delivery concept is applicable. So say this. In X works contract, the supplier, for example, OEM, original equipment manufacturer in the automobile sector, car manufacturer you take, completes delivery at their own factory gate and the property in goods transfers to the buyer, that is dealer at that point. Transport and insurance may be arranged on behalf of the dealer and any loss is claimable by the dealer, that is buyer. As per explanation to section 16(2)(b), goods are deemed to be received when handed over to the transporter on behalf of the buyer, even if physically received at a later date. Okay. So, in our example, July 28th, handed over to transporter, but the goods are actually received on August 3rd. Therefore, the dealer can avail ITC on the date on which goods are billed and handed over to the transporter at OEM's factory gate. At my factory gate itself, as and when the goods are handed over, it is deemed that you have received the goods. Okay. If the goods are, so therefore you can take ITC for which month in our example? July month or August month? July month. You can take ITC, not in August month. If the goods diverted for non-business use or goods are lost, stolen, destroyed, written off or given away as gifts or free samples. So, if the goods are diverted for non-business use, diverted for non-business use means what? So, say from July 27th to August 3rd, you have received it for personal consumption. Even though you can take ITC for July, but you received it for personal consumption, means you should not take. So reverse the ITC. Or during the transit, if the goods are lost, stolen, destroyed or written off, or you have given it as free samples, all these are blocked credits now, you cannot take ITC. So ITC not available, and already you availed ITC, so what you need to do? You need to reverse, and the ITC already availed needs to be reversed. Got it? And this is not only applicable to automobile sector, even though we are discussing it in the context of automobile sector, but this is not only applicable for automobile, for all goods this will be applicable. Applies not only to automobiles but to all goods on ex works contract where ownership transfers at supplier's location. Okay, look into this question related to this. Speed Auto Private Limited, a registered automobile dealer in Chennai, entered into a ex works contract with Messrs Alpha Motors Limited, an original equipment manufacturer located in Pune. So where is the supplier? Alpha Motors, Pune. Speed Auto Private Limited is recipient in Chennai, ex works contract. As per the terms of the contract, the ownership of the goods passed to Speedo Auto at the factory gate of Alpha Motors once the car were handed over to the transporter. Messrs XYZ Logistics arranged by Alpha Motors on behalf of Speed Auto. The details of the transaction are as follows. So transportation anyone can arrange. Transportation can be arranged by recipient or transportation can be arranged by supplier. But ex works contract, the contract gets completed at the factory gate of the supplier. The invoice was issued by Alpha Motors on 20th April. Invoice date is 20th April for 10 cars, each priced at 10 lakh plus GST 28%. Goods were handed over to the transporter at the factory gate on 22nd April. So 22nd April will be taken as the date of receipt of goods. Goods reached Speed Auto's premises in Chennai on 20th April, but 22nd April itself will be treated as the date on which goods are received. Out of 10 cars, 6 cars were sold to customers during May, 2 cars were used by company directors for personal use, 1 car was gifted to a business partner, 1 car was damaged in transit and written off in the books of accounts. Assume that Speed Auto files GSTR 3B within the prescribed time limit. Based on the above facts, answer the following. What is the date of deemed receipt of goods for the purpose of availing ITC? This 22nd April. Because of this clarification, the date on which goods are handed over to the transporter is deemed that Alpha Motors has received. Okay, Alpha Motors, that is recipient is Speed Auto Private Limited, has received the goods. So therefore they can take ITC. So 22nd April will be taken as the date of receipt of goods. Compute the eligible amount of ITC that can claim in the month of April. In the month of April, what happened? Total 10 cars. 10 cars into 10 lakhs into 28%, total 28 lakhs. But the problem is 6 cars sold to customers means they can take ITC. Whereas 2 cars used by directors for personal use not allowed because non-business purpose. 1 car gifted to business partner, blocked. Gifts are free samples. Written off due to damage, blocked credit. So which means literally only 16,80,000 can be taken as credit. And next, that is for the month of April. Would your answer change if the contract had been free on road basis instead of ex works? If it is on free on road basis, the supplier is responsible for delivering the goods to the recipient premises. Therefore, the ownership and delivery would be deemed to take place, and the date of receipt will be 28th April. That is the date on which they can take ITC. However, the amount of ITC eligible will remain unchanged, assuming no disqualification arise later. So, eligible ITC same, but the date on which they are eligible to take ITC will be 28th April. It's a coincidence here that both dates are in the same month, but it may be falling in the another month also. Okay. Next, question number 2, it's an RTP question. Muscat Motors Private Limited, hereinafter referred to as MMPL, a dealer of motor vehicles registered in Udaipur, Rajasthan, has given a ex-works contract to Ganesh Traders registered in Ahmedabad, Gujarat for manufacturing 10 units of pickup vans. Messrs. Ganesh Traders manufactured the vans and handed them over to the transporter on behalf of MMPL on 29th April, and delivery on its part is complete at its factory gate in Ahmedabad. Further, it raised the invoice for all 10 pickup vans on the same day, that is 29th April. MMPL has recorded the invoice in its book on the same day. Price of the vans was 10 lakh each excluding GST 28%. However, The vans were physically received by MMPL at its showroom in Udaipur, Rajasthan on 2nd May. They received it on 2nd May and the payment was also made on the same day. After the payment, 2 vans got damaged completely in a fire in the showroom in the first week of May, and therefore they were written off in the books in the month of receipt by MMPL. Discuss the availability of ITC on pickup vans to MMPL with reference to the provisions under GST law. In which month MMPL is eligible to avail ITC on the purchase of the vans and how much ITC is available in respect of the vans? First, as per the deemed delivery concept, the date on which the vans are handed over to the transporter, that is 29th April, will be deemed to be the date of receipt of goods, so they can avail ITC for April month itself. So 16(2)(b) you need to write. Further, it is X works contract, so therefore they can take ITC. When they can take ITC? In the April month itself. So initially on 29th April, ITC can be availed. How much ITC can be availed? 10 vans into 10 lakhs into 28%, that is 28 lakhs. Subsequently, the vans were received in the May month and 2 vans were destroyed. So therefore, in the May month, they need to reverse the ITC. So ITC in respect of such vans which was already availed has to be reversed while filing the return of the next month, that is May, since ITC on the goods which were destroyed is not available. So what are the 2 vans cost? 10 lakhs into 2 into 28%, 5.6 lakhs needs to be reversed in May month. April month they can take ITC of 28 lakhs and in May month they need to reverse 5.6 lakhs. Okay. So this is a very good question of RTP. There is a chance that this can be asked in exam. So now, when it comes to composition scheme, we don't have any amendments. Then we are moving on to tax invoice, debit notes and credit notes. So in this, there is one point which says that we need to give invoice, and whenever we are issuing invoice, we need to mention the recipient details in invoice. Which means if it is B2B, no doubt we will mention the recipient details. But B2C, whether we need to mention the recipient details or not. So I will tell you what is the provision. Whether recipient details to be mentioned in invoice, B2B always recipient details needs to be mentioned in invoice, but if it is B2C, and if the value of supply exceeds 50,000, no doubt we need to enter, but if it is up to 50,000, we don't have to enter. However, in some cases, irrespective of the value, see B2B always we need to enter, but B2C, irrespective of the value, we need to enter recipient details in invoice. Before amendment, they were supply of services through e-commerce operator, OIDR services and online money gaming. In respect of following case of supplies to unregistered, B2C, the suppliers are mandatorily required to record the name of the state of recipient on the tax invoice irrespective of the value of supply of such services. But now they have made an amendment that not only services through e-commerce operator, all online services are digital services. It may be OIDR service or not a OIDR service, all online services, they are telling that it will be definitely required to enter the recipient details. All online services, OIDR services and online money gaming. Previously services through e-commerce operator only they brought in. OIDR, online money gaming, now also same. Extra is supply of any such online or digital services. Any online or digital services. For example, this OTT, online classes, everything is anyhow OIDR. But even though it is not OIDR services, any online service provided over online consulting, or like this payment transactions, etc. Everything, online contracts will be signed over online. There will be an entity which will send the contract form and you need to sign and give. So all these may not be OIDR service, but even then for all online service also we need to enter the recipient details. In respect of following case of supplies to unregistered recipients, the suppliers are mandatorily required to record the name of state of recipient on the tax invoice irrespective of the value of supply of such services. And what should be taken as a place of supply? Location of recipient. In these cases, anyhow, general provisions only will be applicable. So location of recipient to be taken, and declare the place of supply of the said service as the location of recipient based on the name of state of the recipient in their outward supplies in form GSTR 1. Then, now that is the simple amendment. So, look into this question. Digital One Private Limited, a registered person based in Karnataka, is engaged in providing a range of online or digital services to customers across India. During the month of December 2024, it makes the following supplies to unregistered recipients. Type of service, OTT subscription, streaming service. Mode of supply, supply directly via company website. And recipient location Maharashtra, invoice value 1200, not registered, B2C, definitely we need to enter. And even next one also not registered. All these 4 transactions B2C, correct? All these 4 transactions B2C. OTT, definitely it's a OIDR. E-newspaper subscription, language translation, online quiz game credit, all these will come under the list of online services, OIDR services or online money gaming. So, in this case we need to give, it is anyhow registered recipient means we need to give invoice, but these 4 cases also we need to enter. So, say this, all these cases, in the present case from serial number 1 to 4, state of recipient must be mentioned on the invoice and recipient location must be declared as the place of supply. Also in GSTR 1 or 1A, it will be reported as B2C transaction state-wise. Whenever B2C interstate means, why interstate? Where is the supplier located? Karnataka, and recipient location is in Maharashtra, Gujarat, Tamil Nadu, Kerala, means it is interstate transactions. In case of interstate transactions in B2C, GSTR 1 should be reported state-wise consolidation. Okay. So, that is this, it's a simple question. Then this time limit already we discussed, time limit for self invoice 30 days from the date of receipt of goods or services. That's the time limit for self invoice in case supplier is unregistered and the supply is covered under RCM. Related to that, one question is there. Harsha Textiles Private Limited, a registered company in Tamil Nadu, is engaged in manufacture of garments. The company procured the following supplies in November 2024. Legal consultancy service from Advocate V. Kumar, unregistered supplier, value 50,000, date is 3rd November 2024. So, services, advocate services to recipient, definitely it is RCM and self invoice will be applicable. It is RCM and the supplier is unregistered, so self invoice will be applicable. What is the time limit? 3rd November means we need to take 30 days from 3rd November. So, it will be 3rd December 2024. That is the answer for the first part. Second part, service of GTA, consignment note issued, supplier is registered. Even though it is covered under RCM, because default GTA service is covered under RCM, but as supplier is registered, there is no self invoice that is required, not applicable. Supplier only will issue invoice. Raw cotton purchased from farmer, yes, raw cotton is in the list of notified goods on which GST is payable. This is covered under RCM, list of notified goods under RCM. So, it will be RCM and as supplier is unregistered, it will be covered under RCM. So, whether self invoice is applicable? Yes, self invoice is applicable. So, raw cotton by agriculturist to registered person is notified under 9(3). So, it will be covered under RCM, self invoice to be given within 30 days, that is 7th November 2024. So, plus 30 days, 7th December 2024. Manpower supply service, but this list of goods under RCM is not there for inter, but at final level it is there. Manpower supply service received from SAM Workforce Private Limited. Manpower supply service, supplier should be other than body corporate, then only it will be RCM, but supplier is body corporate, so it will be FCM only. So, self invoice will not be applicable in this case, and supplier only should give the invoice, but supplier is unregistered, so there is no GST. As there is no GST, no invoice. Purchase of steel shelves from a local unregistered trader for office infrastructure, we don't have anything related to this notified for RCM, even though supplier is unregistered, but we don't have it in RCM, it will be FCM only, and as supplier is unregistered, there is no GST in this case. Sponsorship service availed from Chennai Sports Club, a registered entity. Supplier is sponsorship service, supplier should be other than body corporate, yes. Recipient is body corporate or firm, so it will come under RCM, but self invoice not applicable because supplier is registered. So, supplier only will give, self invoice is not applicable. So like this, a question can be created for the purpose of self-invoice and connecting with RCM. And registration, TDS, TCS, GST, payment process, we don't have any amendments. Then in returns, there is one point, TDS return. So GSTR 7 is the TDS return which will be filed by the TDS deductor. Previously, if there were no TDS deducted, return was not required to be filed, but now they have mandated that whether you have TDS deducted or not deducted, you need to file nil return. Every registered person required to deduct tax at source under section 51 shall electronically furnish a return for every calendar month of the deduction made during the month in such form and manner and within such time as may be prescribed, provided that the said registered person shall furnish a return for every calendar month whether or not any deductions have been made. Even if they don't have any TDS deduction, if they are a TDS deductor, nil return at least they need to file. Suppose if they have not filed nil return, will there be any late fee? That late fee is waived off now. Waiver of late fee for delay in filing nil return, provided further that the total amount of late fee payable under section 47 who fails to furnish nil return, stands waived. Right now they have waived, but whenever they wanted to bring, they can bring it into this. Simple part, TDS deductor needs to file nil return. They have to file, simple. If they have not filed, will there be late fee? Right now late fee is waived, but in future it may come. So then accounts and records e-way. In this accounts and records e-way, one simple amendment is there. Unregistered person, whenever the unregistered supplier is supplying the taxable goods. See, the moment goods are taxable, definitely e-way bill is applicable. What if the unregistered person wanted to generate e-way bill? They need to get a unique, enrollment number. Unregistered person opting for generating e-way bill. Yes, transporter can generate or recipient can generate. If the supplier wanted to generate, opting for generating e-way bill, or unregistered interstate supplier of handicrafts, always e-way bill needs to be generated. So these two people, unregistered supplier who is opting for generation of e-way bill, or unregistered interstate supplier of handicrafts, or even unregistered recipient who wanted to generate e-way bill. Now if you want to generate e-way bill, previously just permanent account number can be used for generation, but now what they are telling is that get a unique enrollment number and then only generate the e-way bill. From where you need to get unique enrollment number? From the GST portal, get a unique enrollment number and then generate e-way bill. Who are required to generate unique enrollment number? UEN number 1. Every transporter and warehouse keeper is required to generate unique enrollment number. So UEN is mandatory in the following cases. What are the cases where UEN is applicable under GST? UEN is applicable, unique enrollment number, UN means, is applicable in the following cases. Is applicable in the following cases. This can be asked as a short note question also. This can be asked as a short note question also when UEN is applicable. Number 1, every unregistered transporter, or warehouse keeper. Every unregistered transporter or warehouse keeper. Number 2, unregistered supplier making intrastate supply of goods through e-commerce operator. So if they are making only intrastate supply, generally a person who is making supply of goods through e-commerce operator is compulsorily required to get registered. But if there is an unregistered supplier who is making intrastate supplies through e-commerce operator, making intrastate supplies through e-commerce operator, is also compulsorily getting UEN, not registration. UEN does not mean registration, just the enrollment number. Now number 3, unregistered person opting to generate e-way bill. Then unregistered supplier of handicraft goods, interstate. Unregistered person making interstate supply, that's what is given now, interstate supply of handicrafts, making interstate supply of handicrafts. So these are the 4 people handicrafts. These are the 4 people who are required to generate or who are required to obtain unique enrollment number from the portal, and just because they got unique enrollment number, don't call them as unregistered person. They are registered only. They are registered only. Don't call them as unregistered. They are treated as unregistered. My bad. They are treated as unregistered. Don't call them as registered. Even though they are getting unique enrollment number, don't call them as registered. They are treated as unregistered persons. Okay. So that is about this. So the next area that we are moving on to is segment 16, that is refund under GST. So refund under both options, already we discussed that in zero rated section 16 of IGST Act, which I told you, whenever you are exporting goods upon payment of customs duty, you will neither get option 1 nor option 2, that is refund under both the options is not available. Say this, notwithstanding anything contained in this section, no refund of unutilized ITC on account of zero rated supply of goods or of IGST paid on account of zero rated supply of goods shall be allowed where such zero rated supply of goods is subject to export duty. Mainly in case of exports only it will come. So export of goods upon payment of export duty. Should we remember what are the list of goods which are subject to export duty? Not necessary. That will be given in the question itself. You don't have to separately remember anything in relation to that. Okay. So that will be given in the question itself. Then, and this already we have similar provision in section 16 of IGST Act. In segment 17, assessment and audit, we don't have any amendments. And segment 18, offences and penalties. In this, one simple amendment, that is previously, under section 70, summons were there. Okay, like whenever the officer wanted to call upon a person to appear for the purpose of giving any evidence or document or statement, etc., the proper officer can summon a person whose attendance is necessary. And whenever the officer summons a person, previously there was a confusion, can that person send his authorized representative? Because sometimes some taxpayers may not be able to speak to the officers properly. So they are not well versed with law, etc. and all. So why they need to come? So they can ask their advocate or they can ask their chartered accountant, etc. to go. So previously that confusion was there, can the chartered accountant or an advocate assist or can represent the person to whom summons were issued. So for which clearly in law there was no clarity. Finally, in Finance Act 2024 with effect from 1/1/2024, they have given this. Subsection 1A is proposed to be inserted in section 70 to enable an authorized representative to appear on behalf of the summoned person. So who is an authorized representative? Employee of the person or the relative of the person or chartered accountant, cost accountant, company secretary, or even the advocate, GST practitioner can also go. Authorized representative to appear on behalf of the summoned person before the proper officer in compliance of summons issued by the said officer. The person summoned shall be bound to attend either in person or by an authorized representative. Okay, the person summoned shall be bound to attend. How? Either in person or by an authorized representative, and shall state the truth during the examination or make statement or produce the documents. For example, driver is asked to come and appear before the officer to give the statement that the owner only asked him to transport the goods without any documents, etc. and all. So like that. So during the examination or make statement or produce such documents. Maybe an accountant may be called upon to submit the documents, produce such documents and other things as may be required. So simple one line. So in case of summons, even authorized representative can also appear. Okay. Next, penalty under section 122(1)(b). So on e-commerce operator. So e-commerce operator allowing a supplier to make supplies through their platform, interstate supplies through their platform, even though unregistered, or allowing a person opting for composition scheme to make interstate supply through their platform, or an e-commerce operator is allowing a person under composition scheme to make supply of goods through their platform, or non-furnishing of proper GSTR 8. All these are reasons for which, because there are certain complaints to be followed by e-commerce operator. If they are not doing it, that is the reason why penalty under 122(1)(b) will come. okay. But this penalty was levied only on e-commerce operator, any e-commerce operator. But now they are telling only those e-commerce operator who are liable to deduct TCS under section 52, which means normal e-commerce operator who are liable to pay GST under 9(5), for them this will not be applicable. This is only on e-commerce operator who are liable to deduct TCS under section 52, because not all e-commerce operator are required to deduct TCS, because if you see there are some conditions for TCS, correct? So the supplier should be registered, payment should be collected by the e-commerce operator, the supply should be taxable, and even 9(5) should not be applicable, like that certain conditions are there. So just check, is that e-commerce operator liable to deduct TCS, then only this penalty under 122(1)(b) will be applicable. Then next we have demand and recovery, segment 19. In this demand and recovery chapter, we have a newly added section, that is section 74A, and many students send me messages stating that, sir, should we learn even 73 and 74 also in addition to 74A, or if we learn only 74A, will that be sufficient? Concentrate, carefully listen. This 74A is applicable for the financial year, any tax pertaining to the financial year 24-25 onwards. So financial year 24-25 onwards, if there is any tax due, means just now financial year 24-25 got over and we are still in 2025, and definitely the tax demands may not arise, because for this financial year, what is the time limit within which the notice will be given, etc. and all, is after the annual return. After the annual return for financial year 24-25 only the reality of this section will come. So even though this section is applicable, but the tax demands will be based on the earlier section only. So therefore you need to check the question. Check the question as to this particular short payment of tax or non-payment of tax or wrong availment of ITC or wrong utilization of ITC or erroneous refund. What is that? Short payment of tax, non-payment of tax, wrong availment of ITC, wrong utilization of ITC or erroneous refund pertains to financial year before 24-25, that is up to 23-24, up to 23-24, then in that case 73-74 only will be applicable. If the tax demands pertains to the financial year 24-25 onwards, that year and onwards, then it will be 74A. So therefore please study 73 and 74 also in addition to 74A. Don't just think that only 74A we need to study, because if you see study material also, they have given 73, 74 and even 74A is also given. Trust me, you don't take the chance. Maybe some half an hour effort extra it may take, but it is worth it. Okay. Say this: determination of tax not paid or short paid or erroneously refunded or ITC wrongly availed or utilized for any reason pertaining to financial year 2024-25 onwards. Okay. So that's where section 74A is applicable. So we are just reading the bare act to understand this, and again I have given the summary also related to it. So see subsection 1, where it appears to the proper officer that any tax has not been paid or short paid. Not been paid means you are supposed to pay tax but you have not paid tax, or short paid, you are supposed to pay tax but paid less tax, or erroneously refunded, you are not supposed to get the refund but you got the refund, or where ITC has been wrongly availed or utilized. ITC has been wrongly availed or utilized. Okay. Sir, but if I am availing, there won't be any recovery na sir. Correct. Only when you have utilized there will be. So here wrongly availed or utilized should be understood as availed and utilized. Here wrongly availed or utilized should be understood as availed and utilized, because if you have availed the ITC, the recovery may not come because you need to do the reversal. So the reversal can be done. But what if you don't have balance in ITC? You availed you did not utilize. Then the availed ITC needs to be reversed. But what if you don't have balance in ITC? You have to pay na. So that's why they can recover. So wrongly availed or wrongly availed and utilized. That's how we need to understand. So therefore here the utilized includes availed and utilized. Okay. So you remember non-payment of tax, short payment of tax, erroneous refund, wrong availment of ITC, wrong utilization of ITC. He shall serve a notice. Okay. Proper officer shall serve a notice on the person chargeable with tax which has not been so paid or which has been short paid, or to whom refund has been erroneously paid, or who has wrongly availed or utilized. On the person, they use a word on the person, okay. On the person means even that person can be a registered person or a taxable person. If at all he is required to pay tax, they can invoke this 74A. They did not use the word registered person, they use the word on the person, okay. Chargeable with tax which has not been so paid or which has been short paid, or to whom refund has been erroneously made, or who has wrongly availed and utilized the input tax credit, required him to show cause. Okay. So first a notice will be given, show cause as to why he should not pay the amount specified in the notice. So first there will be a notice along with interest payable under section 50 and penalty levied under the provisions of this act or the rules made thereunder. Got it? So first a notice will be served upon the person. And so here serve notice, what is the meaning of serve notice? Serve notice means what? So serving of notice means usually the time limits etc and all we need to count from the date, not we have given the notice, not the officer has given the notice, the person has received the notice, served notice, okay, provided that no notice shall be issued if the tax which has not been paid or short paid or erroneously refunded or input tax credit has been wrongly availed or utilized in a financial year is less than 1000 rupees, not equal to 1000 rupees, it is less than 1000 rupees. Like this provision we don't have in 73-74. Okay. But sir, one point is there, less than 5000 rupees there is no penalty, that is no penalty, not for recovery. Penalty is not there, yes, no penalty shall be levied. If it is a minor breach, that too, that minor breach should be under section 125 general penalty or section 122 subsection 3, that is wherever there is up to, like that words are used, up to 25,000, up to 10,000, like that, wherever it is used, there only that minor breach point can be invoked, and if the tax is less than 5000 rupees, then the penalty can be waived off. But this is for the applicability of demand and recovery provisions. If it is less than 1000 rupees, there is no demand and recovery, okay. No notice shall be issued if the tax which has not been paid or short paid or erroneously refunded, or where input tax credit has been wrongly availed or utilized in a financial year is less than 1000 rupees. Now what are the points you need to remember based on this subsection 1? 3 points. If it appears to proper officer that tax has not been paid, that is short paid or not paid or erroneously refunded or it is wrongly availed, the officer must issue a show cause notice requiring the person he need to explain why the tax should not be paid along with interest and penalty. However, no notice shall be issued if the amount involved is less than 1000 rupees. Then subsection 2, this is about the basic issuance of notice. Subsection 2 talks about the timeline for issuance of notice. Generally 73-74, what is the time limit for issuance of notice? 73 is 2 years 9 months from the due date of filing annual return, that is 3 years minus 3 months, that is 2 years 9 months. In case of 74, it is 5 years minus 6 months, that is 4 years 6 months, 5 minus 6, that is 4.5 years, 4 years 6 months from the due date of filing annual return, okay. Whereas here you see the proper officer shall issue the notice under subsection 1 within 42 months. So 42 months means how many years it is? 42 months. So basically here 36 months is 3 years, 36 months is 3 years, and thereafter 37, 38, 39, 40, 41, 42. So 3.5 years, literally 3.5 years, okay. 36 months is 3 years here, 42 months is 3.5 years. Literally this 42 months is like 3.5 years, not 3 years, 3.5 years. But when you are writing write 42 months, safer side, because in the law they use the word 42 months, but in some books etc and all summarizing, they will summarize as 3.5 years. from the due date of furnishing of annual return for the financial year to which the tax not paid or short paid or input tax credit wrongly availed or utilized relates to, or within 42 months from the date of erroneous refund. This is same. So if it is short payment, non-payment, wrong availment of ITC, wrong utilization of ITC, so 42 months from the due date of filing annual return. In case of erroneous refund, 42 months from the date of refund. Okay, so that is about this. Okay, now we will move on to the next subsection, statement in continuation of notice. What is that? Where a notice has been issued for any period under subsection 1, the proper officer may serve a statement containing the details of tax not paid or short paid or erroneously refunded or ITC wrongly availed or utilized for such periods other than those covered under subsection 1 on the person chargeable with tax. What is that? This concept is there even in 73, 74 also. For a particular financial year, if the notice is already issued. Now for another financial year also, the same issue is continuing. And at the time of issuance of first notice for the previous financial years, they have not identified it, but subsequently they came to know that for subsequent financial year also this has happened. Now rather than giving a new notice, they will be giving a statement where a notice has been issued for any period under subsection 1. The proper officer may serve a statement. See, it is not mandatory. It is not mandatory, may serve a statement containing the details, okay, so of tax not paid, short paid, erroneously refunded, and for which period? For such periods other than those covered under subsection 1 on the person chargeable with tax. Got it? So it is like supplementary notice or supplementary statement, anyway you can call it as, just a addition to the original notice which is already given. The service of such statement shall be deemed to be service of notice on such person under subsection 1, subject to the condition that the grounds relied upon for such period other than those covered in subsection 1 are the same as are mentioned in the earlier notice. For example, earlier notice is for short payment of tax, that is they collected 18% but they paid only 12%. Short payment of tax, then for subsequent period also it should be for short payment of tax. Okay, so therefore that is this, for subsequent period also it should be for short payment of tax as are mentioned in the earlier notice. The officer may issue a statement covering periods other than those specified in the original notice, and such statement will be treated as part of the original notice if the grounds remain the same. Suppose if the original notice is for wrong availment of ITC but subsequent period is for short payment of tax, can they give a supplementary notice or statement? No, not possible. They need to give a new notice. Okay. Then penalties. What is the penalty in this case? As per subsection 5, the penalty in case where any tax has not been paid or short paid or erroneously refunded, or where ITC has been wrongly availed or utilized for any reason other than the reason of fraud, willful misstatement or suppression of facts to evade tax, that is other than mens rea, guilty mind. So there is a guilty mind that is present, then it is called as fraud, willful misstatement, suppression of facts to evade tax, guilty mind. Okay, so this is bona fide, this is bona fide, the first one is bona fide and the second one is malified, malified intention. Bona fide, it's like error, no intention, but malified is like fraud, there is a intention. So if it is other than fraud, if it is other than fraud, then how much will be the penalty? 10% of the tax due from such person or 10,000 rupees, whichever is higher. Previously for 73, this penalty was there. 10% of tax or ITC or refund, as a case may be. They are telling tax due. Tax due means if it is ITC related offence, ITC. If it is refund related offence, then refund. So 10% of tax or ITC or refund or 10,000 rupees, whichever is higher. This is under each act. This is under each act. Okay. For which means parallelly under SGST Act also it will come. Yes. For the reason of fraud, if it is on account of fraud, then shall be equivalent to tax due from such person, just 100% of the tax or ITC or refund. Previously we used to compare with 10,000, but now the comparison is not there. always 100% of the tax or ITC or refund, that's it. Then look into this. For cases other than fraud, willful misstatement or suppression of facts, the penalty will be 10% of the tax due or 10,000, whichever is higher. For case involving fraud, willful misstatement or suppression, the penalty will be equal to tax due, 100% of the tax. Then subsection 6 and 7 talks about the order. First they gave a notice, then they need to pass the order. What is the time limit within which order will be passed? Here there is a slight difference. In case of 73-74, the order will be passed within 3 years from the due date of annual return, 5 years from the due date of annual return, and the notice we used to work backwards, but here it is not like that. First they gave the time limit for notice, that 3.5 years, and thereafter they will be, that is 42 months we discussed now, 42 months, okay, and thereafter they will be passing an order. The proper officer shall, after considering the representation, if any, made by the person chargeable with tax, determine the amount of tax, interest and penalty due from such person, issue an order. The proper officer shall issue order within 12 months from the date of issuance of notice. So first notice deadline 42 months plus 12 months will be taken as the order date, okay, after considering the representation. Means definitely an opportunity of being heard should be given. Just like that, after notice they should not proceed to the order. After considering the representation, that too there is a word shall, means definitely that should be given, made by the person chargeable with tax. The proper officer shall issue the order within 12 months from the date of notice. Can this 12 months be extended for a period? Now yes, under 74A, yes. This 6 months, this 12 months can be extended further by a maximum of 6 months. Means what you need to remember, 12 plus 6, 12 months plus 6 months, already 42 months, 3.5 years, plus 1, 4.5 years, plus 6, that is 5 years. Now even for non-fraud also, the time limit is 5 years, 3.5 years per notice time limit, plus 1 year plus 6 months. So 3.5 plus 1.5 year, 5 years. Whether it is fraud or non-fraud, they can go up to 5 years. They can go up to 5 years. I mean, time limit is there to pass the order for a particular financial year. Okay, that is something too much it is. The officer, after considering any representation, must determine the tax, interest and penalty and issue an order within 12 months of issuing a notice. So here 12 months from the date of issuance of notice. Issuance of notice means, is it the date they gave the notice or is it the date when recipient has received? They did not use the word, like serving of notice or notice is given. They said issuance of notice. So here there is no clarity. So usually issuance of notice means from the date when they gave the notice will be considered. So whenever they use the word serving the notice or given like that, then we should see from the date on which they have received. But here they use the word issuance of notice. So therefore a clarity is required in this place. Right now for exam purpose you take from the date of notice, whatever is the date on which notice is given by the supplier, given by the department, notice date, notice date. The period may be extended for a further period not exceeding 6 months by commissioner, additional commissioner, joint commissioner. Then voluntarily payment before notice in case of other than fraud. Suppose if it is other than fraud, if you make the payment well in advance, like before notice itself, is there a waiver? Yes. This point was there even in 73. Say the subsection 8, the person chargeable with tax where any tax has not been paid or short paid or erroneously refunded or ITC wrongly availed or utilized for any reason other than fraud may before service of notice pay the applicable tax along with interest, okay, on the basis of his own ascertainment or as ascertained by the proper officer. How proper officer will ascertain? There will be an audit that will be conducted. During that audit easily they will come to know that there is a issue here. So based on that, okay, so own ascertainment or as ascertained by the proper officer and inform the proper officer in writing of such payment, and the proper officer on receipt of such information shall not serve any notice or statement as the case may be in respect of the tax so paid or penalty payable under the provisions of this act. There is no need to pay penalty here, just the interest. This point is wrong. Only the interest along with interest payable under section 50 only given. So before notice, if you pay tax plus interest the notice will not be served, the notice will be dropped. Penalty, no need to pay penalty, okay, no need to pay penalty. They said any penalty, but in this case penalty is not applicable because they said only tax along with interest. Pay the said tax along with interest payable under section 50 within 60 days of issuance of notice. Previously in 73 it was 30 days. Within 30 days from notice if you pay, then there won't be penalty, but here it is within 60 days. 60 days of issuance of notice. Again what we need to pay? Tax plus interest. And on doing so, no penalty shall be payable and all proceedings in respect of such notice shall be deemed to be concluded. Got it? So you need to remember, before notice or within 60 days from notice, if you pay the tax and applicable interest, penalty is not required to be paid. Okay. If the person voluntarily pays the tax and interest before notice issued, no notice will be served. If tax and interest are paid within 60 days after the notice, a person will not be liable to any penalties and all proceedings in respect of the notice will be deemed to be concluded. Then next one, voluntary payment before notice in case of fraud. What is this voluntarily payment before notice in case of fraud? So far what we saw is other than fraud. In case of fraud, before service of notice, pay the amount of tax along with interest and penalty equivalent to 15%. Previously in 74 also same story, 15%. 15%, that is before notice you need to pay 15% of the penalty on the basis of own ascertainment or as ascertained by the proper officer, and inform the proper officer. Then to that extent there won't be any notice. Okay. On receipt of such information shall not serve any notice, means there won't be any further penalty, just that 15% is payable. Okay, you missed that. Then pay the said tax along with interest payable under section 50 and penalty equivalent to 25% of such tax within 60 days. Previously under 74 it was 30 days. So within 60 days from the date of notice you pay tax, interest and 25% of the penalty, same percentage as before, but the time limit is 60 days from notice. Then the proceedings will be deemed to be concluded, means you don't have to pay remaining 75% penalty. Suppose you missed that at a later point of time, but within 60 days from the order date, pay the tax along with interest applicable under section 50 and penalty equivalent to 50% of such tax within 60 days. This is within 30 days. This is within 60 days from the notice. Here it is within 60 days from the communication of order. Please carefully listen. Here the issue of notice they gave. Issue means the date of issue, but communication means the date of receipt. Communication means the date of receipt. It is not the date on which 60 days of communication of order. So they did not use the word issuance of order. Slightly there is a difference. Try to identify this. And on doing so, all proceedings in respect of such notice shall be deemed to be concluded. In case involving fraud or suppression, if the person voluntarily pays the tax and interest along with 15% before notice, there won't be penalty. After notice within 60 days, 75%, and thereafter within 60 days from order, it is 50%. Okay. Then subsection 10. Where the proper officer is of the opinion that the amount paid under clause 1 of subsection 8 or clause 1 of subsection 9 falls short. That is, you paid before notice, but you did not pay fully. You paid before notice, but you did not pay fully. Now for that, can they give a notice again? Yes, possible. Before notice you should have paid whatever you have evaded, you paid but not fully. Fall short of the amount actually payable, he shall proceed to issue notice as provided in respect of such amount which falls short of the amount actually payable. Then next one, this point is there even in 73 subsection 11, self-assessment tax, notwithstanding anything contained in clause 1 or clause 2 of subsection 8. So subsection 8, what is subsection 8? Subsection 8 is this, other than fraud, subsection 8, even if you pay before notice, notwithstanding anything contained in that, penalty will be payable. Penalty will be payable where any amount of self-assessed tax, or any amount collected as tax has not been paid within a period of 30 days. Self-assessed tax or amount collected as tax not paid within 30 days. What is self-assessed tax? Reported in GSTR1 but not paid in 3B, or representing as tax you collected some amount. Even if you pay that before, notice, then there won't be any waiver. There won't be any waiver and you need to make the payment of penalty. Okay. A penalty is applicable where any self-assessed tax or collected tax has not been paid within 30 days from the due date of payment of such tax. Penalty will come. Even if you discharge it before notice, penalty will come. Keep that in mind. Okay. But that too, which penalty? This is applicable in case of non-fraud case. This non-fraud case, because self-assessment tax means non-fraud. The moment when we say self-assessed tax, it is non-fraud. So if it is not reported in GSTR1, definitely it will be a fraud only. Okay. And the provisions of this section shall be applicable for determination of tax pertaining to financial year 24-25 onwards. And for the purpose of this section, the expression all proceedings in respect of the notice shall not include proceedings under section 132. What is 132 proceedings? Imprisonment. Imprisonment may be applicable. Imprisonment may be applicable. Section 132. That will not get relaxed. Where the notice under the same proceedings is issued to the main person liable to pay tax and some other persons, and the such proceedings against the main person have been concluded under this section, the proceedings against all other persons liable to pay penalty under 120 or 125 are deemed to be concluded. Carefully listen. I am the supplier and I have made the supply, but I have not made the supply, and what I did, and I have given you the invoice. I have not made the supply, but I have given you the invoice, on the basis of which you availed the ITC. So previously, on me, there won't be any recovery under 73, 74 or 74A. That is equally applicable now also. Because on me, first of all, there is no liability because I have not made the supply but just gave an invoice. So no issue. You have availed the ITC and utilized it against your liability. Now there will be recovery on you. Got it? Now what you did is that you voluntarily paid before notice. When you voluntarily paid before notice, which means on you the proceedings are concluded, on me also the proceedings will be concluded, which means that there won't be any penalty on me. Are you getting this? If you voluntarily pay before notice, then proceedings are concluded on you. If the proceedings are concluded on you under 74A or 73, 74, this point is common. Even on me also proceedings will be concluded, means there won't be any penalty under 122. Because on me, penalty will be levied under 122. There is one clarification, CBSE clarification, which you need to know. That is, say for example, I am Mr. Amar, you are Mr. Balaji. Same example we discussed. Amar and Balaji. Amar will raise invoice but will not make supply. Now in that case, on Amar, there is no liability because he just raised the invoice. Supply is not made. So liability is not there. But he committed the offense. For which, because invoice without supply, it's an offense. For which penalty will be under 122 subsection 1. Now on you availed the ITC. Now when you avail the ITC and utilized against your liability, now there is because of that reason, your liability came down, means there is a recovery from you. Whenever they made a recovery from you, but before notice itself, you have voluntarily paid that along with the applicable interest or the penalty as case may be. Now the proceedings are concluded on you. There won't be any notice. Correct? The proceedings are concluded on you. When the proceedings are concluded on you, even on me also the proceedings will be concluded. Another example is that I made a supply without invoice. Carefully listen. I made a supply without invoice. When I made a supply without invoice, you should have asked me the invoice. You are an unregistered person. You should have asked me the invoice, but you did not ask me the invoice. So on me, there will be penalty and recovery will definitely be there because I made the supply but invoice not given. So definitely there is non-payment of tax. Recovery will be made from me under 74A as applicable. Now I voluntarily paid the tax along with interest before notice. Now the proceedings are concluded on me. On you there is a penalty called as 122 subsection 3 because you are a party to the offense. You should have asked me the invoice. You did not ask me the invoice. So on you there is a penalty under 122 subsection 3. As the proceedings are concluded on me, on you also the proceedings are concluded. That is this. Where the notice under the same proceedings is issued on the main person liable to pay tax and some other persons, and such proceedings against the main person have been concluded under this section, the proceedings against all the persons liable to pay penalty are deemed to be concluded. For the purpose of this act, the expression suppression shall mean non-declaration of facts or information which a taxable person is required to declare in the written statement, report or any other document. Example, I am making a product and that product, sale of product, that product is taxable at 12%. But in the invoice, I mentioned it as some other product which is taxable at 5%. Actually, I am making a product which is taxable at, sale of product which is taxable at 12%. But in invoice, I mentioned it as some other product or some other HSN which is taxable at 5%. So that amounts to suppression of facts. Okay. And because of this, definitely fraud will come into the picture. That is this. So this is a comparison between existing provision and the proposed provision. Existing 73, 74. 73 is bona fide cases, 74 is modified cases. That is 73 is other than fraud, 74 is on account of fraud, but now 74A is applicable for all cases. Time limit for issuance of notice in case of 73, 3 months before the order due date, whereas 74, 6 months before the order due date. But here it is not like that. 42 months, 3.5 years from the due date of annual return, and in case of erroneous refund, it will be 3.5 years, that from the date of refund. Time limit for issuance of order, here 3 years from the due date of filing annual return. In case of erroneous refund, 3 years from the date of refund. Here 5 years from the due date of annual return or 5 years from the date of erroneous refund. But here it is not like that. First notice, from there within 12 months plus 6 months. 12 months plus 6 months from the date of notice. Effective for all cases. Total applicable time period for completion of adjudication is now 5 years. Invariably, all cases. Applicability, this is up to financial year 23-24, this is from financial year 24-25 and onwards for those tax demands only. Cases covered here, bona fide cases, modified cases. Penalty, here 10% of tax or 10,000 whichever is higher, here 100% of tax or 10,000 whichever is higher. But in this case, 74A, bona fide cases penalty will be same, 10% of tax or 10,000 whichever is higher, but modified case, there the penalty will change as just 100%, there is no comparison with 10,000 rupees. Then pre-show cause notice, before show cause notice if you pay, in case of 73 before notice if you pay there is no penalty. In case of 74 before notice if you pay 15% penalty, here also same ditto. Before notice, if it is non-fraud, before notice no penalty. Fraud case, before notice 15% of tax or IDT you need to pay, same no change. Then after notice within 30 days, after notice within 30 days, 73 no penalty, 74 25% of tax will be payable as penalty. But here it is not 30 days, it is 60 days. Within 60 days and same provision. So other than fraud no penalty, if it is fraud 25% of the tax is payable as penalty. Only thing here 30 days, here it should be taken as 60 days instead of 30 days. After passing the order, if you make the payment, so here there is no relaxation in penalty if it is 73 after order, but here within 30 days from order 50% of tax will be penalty. Here also same, before that is other than fraud, after order no relaxation. Here also same, 50% of the tax is payable as penalty, but only difference is what? In case of 73, 74, they use about 30 days, but here it will be 60 days instead of 30 days. Okay, so that is with respect to this. Thereafter, after 30 days, here anyhow no relaxation, here also no relaxation, 74 also. In case of 74A, other than fraud, no relaxation. Fraud also, after 60 days, there is no relaxation in penalty we need to pay. Got it? This is about 74A. And this differences, if you remember, it is better. If at all a question is coming on 73, 74 also, you will be able to answer this. Now look into consequential amendments in other sections on account of insertion of 74A. There are many places where we come across the reference of 73, 74. I just gave you the extract of all the places where we come across 73, 74. In that place now 74A is also added. One is composition scheme. In composition scheme, if you are not eligible for composition scheme but you continued in the composition scheme, then they will pass an order for recovery. So where 73, 74 mutatis mutandis will be applicable, like that one point is there. So in case of composition scheme, first they will be giving you a notice, CMP 5 and CMP 6 you need to give reply, and CMP 7 they will pass an order denying the composition scheme, and they will recover the tax mutatis mutandis as per section 73, 74, like that is there. Now 74A is also added. Then section 21, in case of section 21, when the input service distributor wrongly distribute the credit, then that credit will be recovered, wrongly distributed credit shall be recovered from the recipient units in terms of 73 and 74, and now 74A is also added in this case. Then section 35, accounts and records. In accounts and records, if the accounts and records are not maintained properly, if there is any misreporting and those transactions are deemed to have been supplied, and the recovery will be made in terms of 73, 74. A registered person failed to account for the goods or services, then the provisions of 73, 74 will applicable. Now 74A also is added there. Then section 49, payment of tax interest. What is the order? First we need to pay the self-assessed tax of the previous tax period, self-assessed tax and other dues of the previous tax period, then self-assessed tax and other dues of the current tax period. Thereafter any amount payable, that is 73 or 74 or 74A. Next, interest on delayed payment of tax. In case of delayed payment of tax, if there is a delay in payment of tax, that is delay in filing 3B. If there is a delay in filing 3B, then in that case the interest will be computed on net liability. But if the tax is paid in terms of 73, 74 or 74A, it will be computed on the gross liability, even though part of the amount is paid from credit ledger and part of the amount is paid from cash ledger. That is this discussion. Then TDS. In TDS also, if there is any short payment of TDS, that will be recovered in terms of 73, 74. Now 74A is also added there. Then section 61, scrutiny of returns. In case of scrutiny of returns, when the officer is satisfied that the returns are not proper, then he may proceed to conducting department audit or special audit, okay, or they can initiate demand and recovery under 73, 74 or 74A. They have added that. Then section 62, assessment of non-filers of return. So when there is a person who is not filing returns, then there will be best judgment assessment. That best judgment assessment order within 30 days, if you file the return, then we will proceed to the tax as per that return only. And there they are telling this particular best judgment assessment is comparable with 73, 74, which means if 73, 74 action is already taken, then best judgment assessment will not come. So that is this, notwithstanding anything to the contrary contained in 73, 74 or 74A, okay, means best judgment assessment is an alternative to demand and recovery. Same way, assessment of unregistered person. There are two best judgment assessment. One is best judgment assessment on non-filers of return. Another is best judgment assessment with respect to unregistered person. Both cases they use the word notwithstanding, means these are alternative to regular demand and recovery provisions. Same way, summary assessment. Summary assessment also, whenever the summary assessment is passed, summary assessment order is passed under section 64, they will proceed accordingly, but within 30 days if you request, then they will withdraw the summary assessment order and they will proceed as per regular demand and recovery 73, 74 or 74A. Then section 65, audit by tax authorities, where audit is conducted under subsection 1 results in detection of tax not paid, short paid, then the proper officer shall proceed to issue a notice or initiate action under 73, 74 or 74A. Same is the case special audit. When special audit is conducted and if there is any recovery of tax, they can initiate 73, 74 or 74A. Then section 75, general provisions relating to determination of tax. In that, where the service of notice or issuance of order is stayed by an order of court or appellate tribunal, the period of such stay shall be excluded in computing the period specified in 73 or 74 or 74A. So usually stay period will be excluded. So for example, if the stay is granted for 6 months, then 6 months the order cannot be passed, so automatically the time limit gets extended. Is it applicable even for 74A? Yes, it is applicable for 74A also. Okay. then the adjudication proceeding shall be deemed to be concluded if the order is not issued within the period specified. So there is a time limit for issuing order. If not issued, then they cannot initiate any action. That is common now for 74A also. Then this one you see, an issue on which appellate authority or appellate tribunal or high court has given its direction, which is prejudicial to the interest of the revenue in some other proceedings, and an appeal to the appellate tribunal or high court or supreme court against such decision of the appellate authority or appellate tribunal or high court is pending. That is, we went to the court on a particular issue and this issue is pending in the court on some other person who is having the same issue. Order cannot be passed because these proceedings, the similar proceedings are in the court. An issue on which appellate authority or appellate tribunal or high court has given its decision, which is prejudicial to the interest of revenue in some other proceedings, and an appeal to the appellate tribunal or high court or the supreme court against such decision of the appellate authority or appellate tribunal or high court is pending. The period spent between the date of decision of the appellate authority, and that of the appellate tribunal, or the date of decision of the appellate tribunal and that of the high court, or the date of decision of the high court to the supreme court, appellate tribunal to high court or high court to supreme court, that period will be excluded in computing the period because that issue is pending in the court. On the same issue, how the order can be passed? Order cannot be passed. For example, that issue is pending in the court for 6 months. For the 6 months, order cannot be passed. So while computing the time limit, that period will be excluded. Excluded in the sense, automatically that gets extended. That 6 months gets extended because at that 6 months, order cannot be passed. That is the meaning. That is now applicable for 74A also. Notwithstanding anything contained in 73 or 74 or 74A, when any amount of self-assessed tax, already we discussed this, self-assessed tax is not paid, then in that case 79 will come into picture. That is direct recovery. There is no notice etc. and all in that case. So in case of self-assessed tax, there is an alternative. Without touching 73, 74A, we can also go for 79. Where any penalty is imposed under 73, 74, 74A, no penalty for the same act or omission shall be imposed on the same person under any other provisions of this act. Already we discussed. So the moment it comes, the penalty under other sections will not come. That's what I told you. Section 122 subsection 1 penalty and 73, 74 penalty is mutually exclusive. That is now applicable for 74A also. Then next section 104. Advance ruling to be void in certain circumstances. That is, sometimes when you get the advance ruling by fraud or misrepresentation, that advance ruling will be void ab initio and any tax which you have not paid can be recovered using 73, 74. Now 74A also applicable. Then section 107, appeals to appellate authority. Whenever the appeal is made to the appellate authority, so here provided further that where the appellate authority is of the opinion that any tax has not been paid or short paid or erroneously refunded or etc. wrongly availed or utilized, no order requiring the appellant to pay such tax or input tax credit shall be passed unless the appellant is given notice. So in court, appellate authority is increasing. Commissioner appeals or GST 80 or High Court is increasing. When they are increasing, a notice should be given, and that notice to show cause against the proposed order, and the order is passed within the time limit. So what is the time limit within which that notice should have been given? Within the time limit under 73, 74 or 74A, okay, shall be passed unless the appellant is given notice to show cause against the proposed order and the order is passed within the time limit, okay. Then power to impose penalty in certain cases, where proper officer is of the view that person is liable to pay penalty and the same is not covered under any other proceeding. Section 127, as per section 127, so proper officer is of the view that person is liable to pay penalty and the same is not covered under any other proceedings. That is, only for levying penalty notice will be given. That notice is 127 notice. Only for levying penalty notice will be given, that is 127 notice. But that will be applicable if there is no other proceedings, means 73, 74, 74A, etc. Like this. These are all the places where there is a reference to 74A, and wherever 73, 74 comes, now it is replaced with 74A. Okay, with just we had round up about all these things. Next, the next area here, 75 subsection 2A, 2A, penalty payable for reason other than fraud if the charge of fraud is not established. What is this? So here, penalty review, if an appellate authority or tribunal or court reviews the case and finds that the charges of fraud, willful misstatement or suppression of facts to evade tax do not hold. So we went to the court, against an order which is issued on account of fraud, and the court is of the opinion that there is no fraud, and if there is no fraud, automatically penalty will come down now. So the penalty under 74A subsection 5, which equals to 100% of the tax, is deemed unsustainable. In such case, the person would still be liable to pay a reduced penalty of 10% of the tax due. Even if you go to the court that there is no fraud, they will not tell, okay, this order is dropped. No, as per that order itself, you need to make the payment, but that payment is penalty, which is 10% of the tax or 10,000, whichever is higher. Got it? No need to check the notice time limit. The same provision we had in 73, 74. So if the order is passed under 74, you went to the court and established that there is no fraud, then they will do the redetermination of tax as if the same order is 73 order or 73 notice and recover accordingly. Here there is no mismatch in the time limit. Whether it is other than fraud or fraud, the notice time limit is same, the order time limit is same. Only relaxation is what you will get. Rather than paying full penalty, you will pay 10% of the tax or 10,000, whichever is higher. If a business is accused of evading taxes by willfully suppressing facts, leading to a penalty of 100% of tax due under section 74A, but during appeal it is found that the suppression was unintentional or due to clerical error, the 100% penalty would be dropped. The taxpayer would instead be liable to pay 10% of the penalty. These are the questions from your solved workbook, which I have modified accordingly to incorporate 73, 74 and 74A. So these questions you can go through, for your practice. I have given all the questions, and if time permits, I will discuss each and every question and I will put it in the YouTube related to this. But I have given, these are basically solved workbook questions. Okay. So let's proceed to segment 20, appeals and revision. In this appeals and revision, there is only one amendment, that is related to pre-deposit. But that pre-deposit itself is a very big amendment. Okay. So here what I am telling is that the pre-deposit, previously it was for the first appeal, so 10% of the disputed tax, that is 100% of the admitted due plus 10% of the disputed tax, subject to a maximum 25 crores under CGST. Okay, this was before amendment. Now what they are telling, 100% of the admitted due same. Admitted due means everything, tax, interest, penalty, plus 10% of disputed tax, subject to maximum 20 crores only. Instead of 25 crores, it is changed to 20 crores. So when it comes to IGST, it will be 40 crores. Same way, second appeal. In case of second appeal, previously before amendment, it was 100% of the admitted due in the second appeal plus 20% of disputed tax. That 20% is subject to 50 crores, like that it was given, but that is also now made as only 10%. So 10% of the disputed tax subject to maximum 20 crores. So what you need to remember as the pre-deposit provision, let it be first appeal or second appeal, it will be 100% of the admitted due. Before going for appeal, how much you are admitting, that you need to pay fully, plus whatever is the appeal you are going, what is the disputed tax in that 10%, but that 10% subject to maximum 20 crores under CGST. If it is total, 40 crores. Okay. Apart from that, the regular penalty 129 we go for appeal now. On penalty we go for appeal, section 129 penalty, that will be 25%, that is same, no change in that. 25% of the penalty will be payable as pre-deposit, no change in that. And I have given all these solved workbook questions related to appeals also. So wherever applicable, I have modified it accordingly and you can go through these questions. This is completely extract from copy paste from solved workbook. So because many students were asking me, sir, share the solved workbook corrections also. That's the reason why I have given here. Okay. Then when it comes to advanced ruling, ethics and other provisions, taxable event under customs, exemptions under customs, classification, valuation, no amendment at all. No amendment at all. And with respect to procedures under customs, there is a change. So this we have studied import of goods at concessional rate of duty rules. So whenever we are importing some goods, either without payment of customs duty or at a concessional rate of customs duty, we need to follow these rules. So a manufacturer or a service provider is eligible for an exemption notification. They are eligible for an exemption notification. Under that exemption notification, either they can import the goods without payment of customs duty or at concessional rate. That imported goods should be used in the manufacture of any commodity or provision of any service. Notified goods manufactured or notified services provided, or we may supply to a specified end use recipient. So manufacture of any commodity or provision of any output service or supply to specified end use recipient, because of that they are giving this exemption. But this output service excludes after sale service, specified end use recipient, supply to intended person in the notification. This can be done by the importer or can get it done on job work basis, but job work is not allowed with respect to gold, jewelry, precious stones, etc. This is the procedure, same, no change. But here a slight change is there. Previously, the unutilized goods or defective goods needs to be either exported or sold in India within 6 months. That within 6 months is extended for 1 year plus 3 months from the date of import. Previously, any goods which are imported under these rules, concessional rate or without payment of duty, if it is not utilized, within 6 months it should be either exported back or sold in India upon payment of duty or with applicable interest. But now the time limit has been extended to 1 year and it can be further extended for a period of 3 months from the date of import. So this is the amendment here. This is the amendment. This is the amendment. This area is the amendment. Okay. Next, another point is that these FAQs are all same. Previously, they used to file a monthly statement, but now they need to file a quarterly statement. Under these rules, they used to file a monthly statement, but now they need to file a quarterly statement. Then one more point is that if the goods are sent on job work, it should be returned within 6 months, like that it is there. Those manufacturers who import goods under these rules, if they are sending it for job work, it should be returned within 6 months is there. That has been extended to 1 year. So monthly statement has become quarterly statement. These are the changes. And next, we don't have any other change, everything literally copy paste same. And here there was a confusion while calculating the depreciable value for capital goods. Capital goods imported and used and then sold, what should be taken as the depreciable value? For every quarter or part thereof, in the first year 4%, second and third year 3%, and third and fourth and fifth year it will be 2.5% and thereafter 2%. How to compute the quarter? Calendar quarter, like that we took the assumption that gave in the law itself. We need to take the quarter period comprising of 3 months ending March, June, September and December, like that we need to take. Okay. Next, unutilized goods 1 year plus 3 months, and quarterly statement time limit is same, 10th of the month following every month. Okay. So that is with respect to this. And look into this question. This is an RTP question which they have given. Shuhashi Electronics Private Limited, an importer who availed the benefit of notification, imported the raw materials for manufacturing LED panels. No condition or time period has been specified in the notification in relation to re-export of unutilized or defective goods. So the goods were imported on on 10th February. 10th February they imported, carefully listen, 10th February. However, a small portion of the goods received were found to be defective and remained unutilized due to a production shift in the company. Shuhashi Electronics approached you, obtain advice for dealing with this defective and unutilized goods on the basis of the provisions of customs. Import of goods at concessional rate of duty rules 2022, you are required to discuss whether Shuhashi Electronics can re-export these unutilized or defective goods. If yes, what is the maximum permissible time period? So 1 year plus 3 months. within a period of 1 year, within the period specified in the notification, within 1 year from the date of import. However, the period of 1 year can be extended for a further period not exceeding 3 months on sufficient cause being shown. Okay, so that is what we need to write. So when is it imported? 10th February 2024. So the re-export should be made within 1 year from the date 9th February 2025, and it can be extended for a further 3 months. But actually it should be 10th February 2025. It should not be 9th February, because when it is 1 year, we just add the year only. We will not add the like months like that. So it should have been, as per RTP they gave 9th February, but according to me it should have been 10th February. What are the conditions applicable in case of re-export of goods? In case of re-export of goods, that should be reported in a quarterly statement. I told you previously monthly, now quarterly statement. And the value of that re-export goods shall not be less than the value of said goods at the time of import. Okay, the value should be more. The value of such goods for re-export shall not be less than, means what? Should be more than the value of the said goods at the time of import. This is already there in the rules. Value of such goods should be greater than the value of said goods at the time of import. Okay. Then next one, if Shuhaji Electronics chooses to clear the goods for home consumption, explain the procedure for the same. They need to pay the customs duty along with interest at 15% per annum. So it can make voluntary payment of applicable customs duty along with interest, and the details of the duty payment and clearance should be reported in quarterly statement. So this is the only amendment in customs. Baggage, stores, warehousing, refunds, there is no amendment. Then when it comes to foreign trade policy, one small amendment is there. That is stakeholder consultation by government. That is, government may ask for suggestion from exporters. So what is the stakeholder consultation? Before making any changes to foreign trade policy, they can ask the importers and exporters an opinion. Okay, may ask for suggestion from exporters, importers and experts while making or changing the foreign trade policy. If the suggestions are asked, 30 days may be given to respond. However, the government may make changes without asking anyone, not compulsory. Then why they brought this? Why they brought this? If suggestions are not accepted, government will explain why. But this explanation and all they will not give if that suggestion why they are not accepting, they will not give explanation. Why they will not give explanation? Provided it affects the trade with the other country or national security, or it goes against government policies, or it is irrelevant or benefits only few people, or it requires sharing confidential details. That's why they will not be giving the reason why they wanted to not accept your suggestion. No one has legal right to demand reasons if their suggestions is not accepted. Okay, I gave a suggestion, they did not accept, like that you cannot file a case on them. So this is one stakeholder consultation concept in FTP. With this, we completed all the amendments which are applicable for your September 25 exam. And what you need to do is that just in your That's It book, you just make these incorporation. There are few amendments only, not much amendments. Either you can go and buy the new That's It book. No sir, I want to make use of May attempt That's It book. You can just incorporate these changes, and wherever required I have given in the chart form only. Just incorporate that points, that is sufficient. Anyhow, notes is given in the That's It book. In that space, you just incorporate this in summary form, that is sufficient. And so with this, we completed our amendments video, and all the very best for your exam. Don't worry, this is not just the conclusion. So as you are asking for amendments, I just gave amendments, and definitely I will be releasing with mighty 50 questions and the chapter wise revision videos. Many people were asking me, sir, will you take rocket revision this time? Last time only I took the rocket revision, and the same rocket revision is sufficient. Just these amendments you incorporate, and with that, that is sufficient. You don't have to read anything further. The previous batch rocket revision is more than sufficient. Okay, and the chapter wise revision video is also available. You can just follow that only. Thank you, and we will meet again with some other mighty 50 and other MCQ related videos, etc. So whatever best I can do, definitely I will do for you. I am there, don't worry about that. Till the time you go for exams, I am there. Okay, thank you all, take care, bye.